Please like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're diving into a powerful investment strategy that didn't just tweak the rules for active managers, it basically blew the doors off, completely changing how they could hunt for alpha.
You know, it all really kicked off with this one simple but honestly pretty profound statement. This was presented to the board of CalPERS, one of the biggest pension funds on the planet, and it just perfectly captured the whole idea of long-short investing. It really set the stage for a massive shift in how big institutions thought about their portfolios.
Alright, so here's our game plan for today. First, we're going to dig into the big problem that active managers were stuck with. Then we'll see how the 1330 strategy swooped in as the solution. We'll get into the science that makes it all work, check out the ripple effects it had, talk about the risks, gotta do that, and then see what it all means for the future of investing.
Okay, first things first. To really get why the solution was so brilliant, you have to understand the problem. And for active managers, the problem was huge. They were pretty much trapped, handcuffed to their benchmarks.
So in the world of asset management, you've basically got two kinds of players. You've got your beta grazers, think of them like index funds. Their job is to just ride the market wave as cheaply as possible. Then you have the alpha hunters. These are the folks who get paid the big bucks to use their skill to make smart bets and to actually beat the market.
But here's the real dilemma. A lot of these so-called alpha hunters are actually just beta grazers in a very expensive disguise. I mean, look at this real-world example. An active manager with an R-square of 0.994 against the S&P 500. R-square is just a stat that tells you how much a fund moves like its benchmark. And 0.994? That means it's a near-perfect clone. They're hugging that benchmark so tightly that the only thing they can guarantee is underperforming by the exact amount of their own fees.
So what's going on here? The core of the issue, the thing that was holding back even the smartest managers, was this one fundamental rule of old-school investing. It's called the long-only constraint.
So how do you break those handcuffs? Well, this is where the 130/30 strategy walks onto the stage. And honestly, it's a pretty elegant solution. Let me show you what that constraint really looks like. Imagine you're a fund manager, and you think some small company in the Russell 1000 index is just a total dog. In a traditional fund, what's the biggest bet you can make against it? Well, you just don't own it. But if that stock is only a tiny fraction of the index, say 0.04%, your bet is basically meaningless. Your negative insight, your skill, is totally wasted.
The 130/30 strategy just smashes that limit. It's actually super clever. Let's say you start with $100. Step 1, you find $30 worth of stocks that you think are losers. Step 2, you short them, which basically means you borrow them and sell them, and that gives you $30 in cash. Then step 3, you take that $30 and you plow it right back into the stocks you absolutely love, your best ideas. And what you end up with is this totally new kind of portfolio. You're now 130% long your favorite stocks and 30% short your least favorite. You've literally supercharged your ability to act on your best ideas, both the good and the bad, all while keeping your total market exposure at 100%, just like a regular old fund.
So that's the how, but what about the why? Why does this actually work? Well, it's not just some clever accounting trick. It's actually grounded in the core mathematics of trying to beat the market, something called the fundamental law of active management.
Seriously, you can think of this as like the E equals MC squared of active management. It's a formula that dictates how a manager's skill gets turned into actual performance, into alpha, and every single active manager out there, whether they know it or not, is living by the rules of this law.
Okay, let's break this down real quick. Your information ratio, the IR, that's your final grade. It's your alpha divided by your risk. And that grade depends on three things. First is your IC. That's your raw skill in picking stocks. Then there's breadth. That's just how many different bets you can make. And then there's the really important one for our story, the TC, or transfer coefficient. That's just a fancy term for your freedom to actually act on your ideas.
And here, right here, is the smoking gun. Researchers found that being long-only is the single biggest thing holding managers back. It directly crushes that transfer coefficient, that freedom, and it can gut their ability to turn their skill into results by as much as 40%. That's huge.
So, the 130/30 strategy is the perfect antidote. By letting managers short stocks, it directly boosts the two key parts of the formula. It cranks up the transfer coefficient by giving them the freedom to bet against stocks, and it increases their breadth by opening up this whole new world of shorting opportunities. More freedom, more opportunities, well, that means a much better chance at a higher score. Now, the impact of this wasn't just on paper. It sent real shockwaves through the entire industry, leading to more transparency, much fairer fees, and just better alignment between investors and the people managing their money.
And this is where the strategy got truly disruptive. See, 10 years ago, if a manager wanted to do this, they'd have to launch a hedge fund and charge that classic, crazy 2 and 20 fee. But these 30/30 products came out of the traditional investment world, and they just blew that model to bits, offering the same kind of power for way, way less.
This whole shift just shone a bright light into what used to be a really murky corner of the market. And transparency, as we all know, is the absolute foundation of good governance. It makes sure everyone's interests are aligned, and it cuts down on the risk that one side knows a whole lot more than the other.
But of course, this new superpower doesn't come for free. When you unlock the power of shorting, you also introduce a whole new set of risks and headaches that managers have to be really smart about.
So what is the catch? What are the things you have to worry about when you start playing on the short side of the market?
Well, there are some real practical hurdles. Sometimes the stock you want to short is just plain hard to get your hands on. Or the person who lent it to you can ask for it back at the worst possible time. Then you've got the famous short squeeze, where a stock starts rising and all the short sellers are forced to buy it back, which just throws gasoline on the fire. And, of course, there's the theoretical risk that since a stock can go up forever, your losses could be, well, unlimited.
But here's the thing. While those risks are absolutely real and you need some serious risk management to handle them, the big takeaway from the source material is pretty clear. For a manager who knows what they're doing, these problems are manageable, and the incredible benefits of breaking free from that long-only prison far outweigh the extra hassle.
So where does that leave us? Well, the 130/30 strategy wasn't really the final chapter. In a lot of ways, it was just the beginning of a whole new book for active investing.
When you really think about it, the 130/30 idea was a gateway drug. It opened the door for even more flexible funds and proved that the industry could handle, and even thrive on, more sophisticated strategies. And it leaves us with this one really important question. In a market that is always changing, always evolving, is the biggest risk you can take maybe just sticking to the rules of yesterday?
All right, let's dive right in. Today, we're digging into a really fascinating Morgan Stanley paper on a powerful investment strategy called active 130/30 extensions. And trust me, it's a technique that's going to challenge some of the most basic ideas you have about portfolio risk. So let me ask you something right off the bat. Take a second and think about your investment portfolio. You've probably put a lot of work into making sure it's well diversified, right? But what if I told you there's a massive, hidden risk factor that's completely dominating almost everything inside it? And you know what? The authors of the paper we're looking at have this brilliant metaphor for it. They call it the 800-pound equity gorilla. And it is big, it is powerful, and it's sitting right there in the middle of your portfolio, even if you can't see it. All right, so first up, let's go ahead and unmask this gorilla. We're going to see how even the most complex, sophisticated portfolios often aren't nearly as diversified as we think they are, all because they share one single massive source of risk. Okay, get ready for this number. It's a big one. The source points out that for pretty much any asset allocation you can think of, 90% or even more of its total risk, its volatility, comes directly from the stock market. Just let that sink in. 9/10 of your risk is really just equity risk in disguise. And this table here, man, it just proves the point perfectly. I mean, look at a classic 60/40 portfolio. No big shocker, 97% of its volatility is from stocks. But check out the modern diversified fund. This thing has private equity, real estate, all the stuff you're supposed to add to spread out risk. And still, 90% of its risk is being driven by the equity market. The gorilla is literally everywhere. So, if we can't really escape this gorilla of market risk, what's the move here? Well, this brings us to the really cool solution proposed in the paper, a strategy designed not just to ride the market, but to actively hunt for those extra returns, what the pros call alpha. So the strategy is called an active extension, or more commonly, 130/30. Stick with me here, it's actually pretty simple. A manager takes a normal portfolio, and then they short 30% of it, which is just a fancy way of saying they're betting that certain stocks are going to go down. They take the cash from that bet and buy 30% more of the stocks they're really, really excited about. So you end up 130% long on stocks you think will go up and 30% short, but your total exposure to the market is still 100%, just like a regular old fund. So the whole point here is that this structure just amplifies a manager's skill. You start with your normal portfolio. Then you find the stocks you think are losers and you short them. You take that cash and you plow it right back into your absolute best ideas. And the result, which is the key takeaway, is that you can basically double the active bets you're making in your portfolio.
And this is where you really see the power of this thing. In the paper's example, a standard manager generates, say, 1.5% of alpha. But by using this 130-30 structure, they can more than double that to 3.3%. And why is that? Well, it's because they can finally make money from their bad ideas, not just their good ones. They've unlocked a whole new engine for returns.
But you know how it goes in finance, right? There's no such thing as a free lunch. This extra firepower for generating alpha brings in a different kind of risk we have to get our heads around. And that risk is called tracking error. Tracking error, or TE for short, is really just a way of measuring how much your portfolio zigs and zags compared to its benchmark, like the S&P 500. If you have a low tracking error, you're basically just hugging the index. But a high tracking error means your returns could be wildly different, for better or for worse. It's the price you pay for being active. Now, this is crucial. Not all 130-30 strategies are the same. This slide shows you the dangerous way to do it. Let's say your long picks and your short picks are both exposed to the same market forces, like you're long one tech stock and short another just because you think one will do a little better. They're positively correlated. In that case, your risks don't cancel each other out. They actually stack up. And you can see it right here. The tracking error literally doubles from 3% to 6%. That's a huge jump. But here's the smart way to do it. If your shorts are negatively correlated with your longs, they act like a hedge. So for example, you could use your short positions to cancel out an unintended growth bias you have in your long portfolio. The source calls this an offset correlation, and just look at the difference. The tracking error only bumps up a little bit, from 3% to 4.2%. That's a much, much better risk-reward trade-off. And this brings us to a really subtle but super important point from the paper. See, a lot of investors chase what's called a high information ratio, which is basically a measure of the smoothest ride, the most alpha for the least amount of risk. But what the authors are saying here is, hey, maybe chasing the smoothest ride means you're actually leaving bigger returns on the table. Sometimes you have to accept the right kind of bumps in the road to get the best result overall. Okay, so let's zoom out for a second. We've been deep in the weeds of one strategy, but how does this all look from the top? What happens when you drop this one piece back into the huge puzzle of an entire pension fund or an endowment? And this is where we come full circle, right back to our gorilla. The paper's most powerful insight, honestly, is this. Because the entire fund's risk is so completely dominated by the stock market, that small, uncorrelated tracking error from our little 1330 strategy, it just gets completely swamped. It's like a tiny ripple in a massive ocean of market risk. And here's the stunning proof. In the paper's main example, adding a 130-30 strategy that's generating a ton of alpha increases the total fund's volatility from 10.45% to just 10.46%. That's an increase of, wait for it, 0.01%. For all practical purposes, the added risk is basically zero. It's a rounding error. Okay, I know what you're thinking. That's great when things are calm, but what happens when the market absolutely panics, when everything tanks and correlations all go to one? It's a fantastic question, and yeah, the paper goes there. To understand this, we need a new concept, stress beta. Think of it like this. On a calm day, all the different boats in the harbor are doing their own thing. That's diversification. But when a hurricane hits, every single boat, I don't care what it's made of, gets shoved in the same direction by the wind. In a financial crisis, assets that seemed totally different suddenly move in lockstep with the market. Their beta just skyrockets. And this slide shows you just how scary that can be. In normal times, diversification is your best friend, but in a crisis, it can completely fall apart. And the irony, as the source points out, is that those super diversified funds can actually be the most vulnerable, with their risks spiking by 36% or more. But a 130-30 strategy is built differently. Because its active risk comes from both longs and shorts, it's theoretically designed to be independent of what the overall market is doing. All right, let's pull all this together. We've talked about the problem, that hidden gorilla, we've looked at the solution, the 130-30 strategy, and we've dug into the risks. So, what are the big things you really need to walk away with? Okay, here's the highlight reel. First, that 800-pound equity gorilla is real, and it's running the show in almost every portfolio. Second, 130-30 strategies are a pretty brilliant tool for unlocking a manager's full skill set, letting them make money when they're right about a stock going up or down. Third, yeah, this adds a new risk called tracking error, but you can manage it if you're smart about it. And finally, and this is the big one, when you look at the whole picture, the added risk is just a drop in the bucket, totally swamped by the massive market risk you already have. I want to leave you with one more great quote from one of the paper's authors, Martin Leibowitz. He frames the entire investment world with this amazing metaphor. You've got beta grazers, who are just passively eating whatever the market gives them, and then you have alpha hunters, who are actively going out to find those extra returns. And really, that's the final question to chew on. In a world where we know that 800-pound gorilla of market risk is just unavoidable, is it really enough to just be a beta grazer, passively riding along? Or is it maybe time to become an alpha hunter and start using sophisticated, risk-controlled strategies like 130/30 to go out and find the returns that other people are leaving on the table? Welcome to The Explainer. Today, we're digging into a really powerful portfolio strategy, one that basically changes the rules of the game for active investing. It's called active extension, and trust me, by the end of this, you're going to see exactly how it can unlock a portfolio's true potential.
So let me ask you this. How do you win a game when the rules won't let you make your best moves? I mean, imagine you're a chess grandmaster, but you're told you can only move pieces forward. Or you're a star quarterback, but you're not allowed to throw the long ball. It'd be beyond frustrating, right? Well, for a very long time, this was the reality for active investment managers trying to beat the market. They were playing with one hand tied behind their back. And that leads us right into the heart of the problem, what we're going to call the investor's dilemma. It's this fundamental conflict that's just baked into the way traditional active investing has always been done. See, every active manager is basically juggling two jobs at the same time. Job number one is to deliver beta. That's just a fancy way of saying they need to capture the market's overall return. You know, you can't fall behind the benchmark. But their second job, the one that really matters, is to deliver alpha. Alpha is the secret sauce. It's that extra return above the benchmark that, frankly, justifies their fees. But here's the catch. To get that alpha, you can't just copy the market. You have to be different. You have to make active bets, choosing to own more of some stocks and less of others. That deviation, that's where alpha is born. But as you can probably guess, it's also where all the problems start. So let's dissect this hidden rule that creates the whole problem. We're going to get into the anatomy of the constraint that holds so many portfolios back from what they could really be. Okay, to really get this, we can think of any active portfolio as having two different parts. First up, you've got the core component. Its only job is to track the benchmark, right? To deliver that beta we just talked about. And then, second, you have the alpha component. This is your engine. This is the part that's supposed to generate those extra returns from your best ideas. So the portfolio itself is really just the sum of its parts. A core engine trying to match the market, plus this set of active alpha bets trying to beat it. And this simple formula, it is the key to understanding everything that's coming next. And this brings us to the culprit, the big one. It's called the long-only constraint. And it sounds so simple, almost obvious. You just can't own less than zero of a stock. But this one single rule completely warps a manager's ability to express their ideas, especially their negative ones. Now check this out. This visualizes the problem perfectly. We're looking at the weights of stocks in the S&P 500. Just look at that. You see how a tiny handful of stocks way over on the left have these huge weights, and then you've got hundreds and hundreds of others with weights that are just minuscule? This is pretty much how every major market index looks. And here is the absolutely crucial point. If you love a stock, you can overweight it in a big way. You can make a huge bet. But what if you think a stock is a total dog? Well, because of that long-only rule, your ability to bet against it is capped by its tiny little weight in the index. For most stocks, the biggest bet you can make against them is a fraction of a percent. Your negative opinions? They're basically silenced. I mean, this is a massive, massive inefficiency. But what if we could just break that rule? What if we could unlock the portfolio and let managers really express all of their ideas, both the good and the bad? Well, that's exactly where the solution is. This is where active extension, or AE, comes into the picture. Now, you might have heard of strategies like 13/30.
At their core, these are all strategies that relax that long-only constraint. What they do is give managers the ability to go short. That is, to borrow a stock they don't like, sell it, and create a negative position, effectively betting that its price is going to fall. And let's be clear, this isn't just some small tweak. This is a total game changer. All of a sudden, a manager's conviction can be symmetrical. They can make big bets on the stocks they love and big bets against the stocks they can't stand. The portfolio can finally become a true, unconstrained expression of their best ideas. So, what does all this newfound freedom actually get you? Well, this is where it gets really interesting. The source material lays out two totally different paths to improvement. It's not just about getting more return. It's about a choice between getting more alpha or getting better alpha. You can actually visualize this trade-off on a simple grid. So think of the horizontal axis as the quantity of your active bets. That's your active weight, or how much you're straying from the benchmark. Then the vertical axis represents the quality of those bets. Investors have a measure for this called the information ratio, which is basically asking, pound for pound, how good are your insights? And active extension is so powerful because it lets you improve along both of these dimensions. Okay, so this gives you a choice. Path number one is more alpha. You take your existing portfolio and just scale everything up, using the short positions to fund even bigger long positions. That's a horizontal move on our grid. You're taking more risk for more potential return, but the underlying quality of your ideas is the same. Path two is better alpha. Here, you keep your overall risk level the same, but you restructure the portfolio, using those new short positions to really hammer home your negative views. This is a vertical move, same risk, but higher quality. That leads to better risk-adjusted returns. But wait, the benefits don't even stop there. Active extension also fixes this really subtle but critical flaw in the portfolio's core engine, a hidden drag on performance that, honestly, most investors don't even realize is there. It's a concept called dead weight loss tracking risk. Think about it. In a normal, long-only portfolio, if you want to buy more of a stock you love, you have to sell something else to get the cash. And a lot of the time, that means selling a stock you feel totally neutral about, one that's just part of the benchmark. This creates a new risk, right? Your portfolio doesn't perfectly track the market anymore. But it's uncompensated risk. You're not expecting to get paid for taking it. The absolute best analogy for this is engine friction. It's just wasted energy. This dead weight loss is a wasted risk budget. It's useless tracking error that heats up the portfolio but produces no expected return, and it just drags down your overall efficiency. And this is where active extension is just brilliant. It provides a new source of funding, the cash you get from your short sales. So now you don't have to cannibalize your core portfolio to fund your active bets. The core can be left alone to do its one job perfectly, track the benchmark with almost no friction. The entire system just becomes way more efficient. So when you put all of these pieces together, what you get isn't just some new product. It's a whole new framework, a new way of thinking about building a portfolio and active management in general. And this is the key takeaway. You have to stop thinking about active extension as just some rigid formula, like 130-30. It's not a number. It's a two-dimensional space. Every single portfolio lives somewhere on that grid of quantity of alpha versus quality of alpha. The real power here is having the freedom to choose exactly where on that grid you want to be. The source material really puts it perfectly. It says the future of active management isn't about picking some number, like 130 or 150. It's about having a much more sophisticated conversation, one about finding the optimal combination of the quality of your insights and the quantity of risk you're willing to take to express them. Which really leaves us with one final powerful question. When you look at any investment strategy from now on, you can ask this: is it just designed to amplify the bets that are already there to get you more? Or is it intelligently structured to improve the quality and the efficiency of those bets, to be fundamentally better? Active extension, for the first time, gives managers the tools to do both.
All right, let's get right into it. Today, we're talking about something called active extension portfolios. Now, these are really sophisticated strategies that promise, bigger and better returns. But what if the very tools everyone uses to manage their risk are, well, built on a shaky foundation? We're going to pull back the curtain on the hidden dangers that can pop up in the hunt for alpha.
So here's our game plan. First,
We'll look at why these portfolios are so appealing. Then, we'll bust a huge myth about how the market actually behaves. From there, we'll dig into the real danger this creates, a new model that tries to fix it, and finally, what this all means for the tough choices managers have to make.
Okay, first things first. Why are we even talking about active extension portfolios? What's the big deal? What is the promise that gets so many sophisticated investors so excited?
Well, this slide really gets to the heart of it, and it all boils down to one thing: freedom. You see, a traditional manager, they can only bet on the stocks they love. The most they can dislike a stock is to just not own it. Their bet against it is capped at 0. But an active extension, or AE portfolio, it can short sell, it can actively bet against stocks. This opens up a whole new world. You can go for more alpha just by making your existing good ideas bigger, or you can go for better alpha by finding totally new ways to bet that just weren't possible before.
Okay, but here's where we find the crack in the foundation. The entire system for managing risk in these really complex portfolios, it all rests on one single powerful assumption about how markets work. And as we're about to see, that assumption is basically a myth.
The tool everyone uses is called a linear factor model. You can think of it as the engine of risk management. It's supposed to tell you where your risks are coming from. But this whole engine, the whole thing, is built assuming that stock returns are normal, that they fit neatly inside that perfect, predictable bell curve we all learned about in stats class.
So the whole system is riding on this one idea. And that leads us to the absolute most important question you see right here. Does the real world actually look like the model? Are stock market returns really that, well, normal?
And wow, this chart just says it all. The thin line is the theory, that perfect little bell curve. The bars, that's reality. That's what actually happened over 11 years. And just look at the edges, the fat tails as they're called. These huge moves, both up and down, happen way, way more often than the standard model predicts. The market isn't normal at all. It's much, much wilder.
And let's be clear, these aren't just one-off black swan events. This isn't a fluke. The data shows these massive outlier returns are a constant, persistent feature of how the market works. We're talking month after month, year after year. The number of stocks making these crazy moves is way higher than the model expects. This isn't the exception, it's the rule.
Okay, so the model is flawed. We've established that. So what? Why does it matter? Well, now let's see how this flaw creates a very specific and a very serious danger for active extension portfolios, the ones that are betting both for and against the market.
The size of these moves is just mind-blowing. We are not talking about little blips on a screen. The average outlier stock, one of those stocks out in the fat tails, moved plus or minus 38% in a single month. I mean, think about that. That kind of explosion can absolutely destroy a portfolio or make it.
And here's where it gets super tricky for these AE strategies. See, managers who only own stocks, they've spent decades getting good at avoiding negative outliers. You know, a company they own blowing up because of a profit warning. They know how to look for that. But a positive outlier, a stock that suddenly screams higher, that's an absolute catastrophe if you're shorting it. And these events are a totally different animal. They're often caused by things you can't predict by just looking at a company's balance sheet, like a surprise takeover bid.
This quote just nails it. The risk when you own a stock is mostly about that company, but the risk when you short a stock, that can come from completely outside the company. It can be driven by some other company deciding to buy them out. That makes the risk fundamentally different and a heck of a lot harder to manage.
Okay, so if the standard risk models are broken because they're blind to these fat tails, what's the fix? How can we possibly build a better model that actually accounts for this wild, unpredictable danger?
Well, the solution is pretty clever. It's not about trying to predict the next specific company to have a huge move, because that's basically impossible. It's a statistical approach. First, you group every stock by its basic DNA, its sector, its style, like growth or value, and its size. Then, you look back through history and calculate the odds. For each of those groups, how often did an outlier event happen and how big was it? And finally, you bundle all that data up to create a brand new, explicit risk factor for outliers.
And this is what you get: a much more honest, much more complete picture of risk. The old models just had two pieces of the puzzle: market risk and company risk. This new equation adds that third, absolutely critical component: outlier risk. It says, hey, we know these crazy things happen, so let's actually measure it.
And this table just breaks it down beautifully. You've got your systematic risk, the stuff that affects everybody, like interest rates. You have your idiosyncratic risk, the normal, everyday stuff happening at a specific company. And now you have this new player on the field, outlier risk, which finally gives a name and a number to the danger from those extreme, fat tail events that the old model just pretended didn't exist.
So let's bring it all home. We have this new, smarter way to see and measure a hidden risk. How does that actually change the decisions a portfolio manager has to make every single day?
Well, one of the key ways this outlier risk appears is something called gap risk. This is when a stock's price doesn't just move, it teleports. It opens the next morning at a completely different price because of overnight news, like that buyout we talked about. There's no chance to get out. A stop-loss order? Totally useless. The price gaps right over it, and the damage is done in an instant.
And this forces a really tough choice. A manager can go chasing better alpha. They can make these bold, concentrated short bets. But now they know that by doing that, they are dramatically cranking up their exposure to this unpredictable, unstoppable gap risk. The other option? Go for more alpha. Just take your existing, diversified ideas and scale them up. This keeps the portfolio more balanced and way less vulnerable to a single catastrophic blow-up.
And this, right here, is the big, profound takeaway from all of this analysis. Once you can actually see and measure the hidden risk of outliers, the smartest choice is often not the boldest one. It's to be more cautious, to focus on getting more out of the bets you already understand, instead of chasing better returns down a path that's filled with hidden traps.
Which really leaves us with this final question to think about. In a market that we know for a fact is not normal, maybe the smartest move isn't about being the most aggressive. Maybe true genius is about being the most resilient, building a portfolio that can withstand the shocks you know are coming, even if you can't predict exactly when or where they'll hit.
So what if your investment manager had access to a strategy that let them act on all their best ideas, not just the ones they feel good about, but the ones they think are going to fail too? Well, there is one. It's called active extension, or maybe you've heard of it as 120/20. We're going to break down exactly how it works and why it just might be a game changer for active management.
All right, here's the plan. First, we need to understand the hidden constraints of traditional funds, what we're calling the long-only handcuffs. Then, we'll see how active extension strategies can break them. After that, we'll dive into where managers actually hunt for those winning and losing stocks, see the strategy in action with some real numbers, and finally, we'll weigh the risks and rewards.
So, to really get why a strategy like 120/20 even exists, we have to start with a fundamental problem, a limitation that pretty much every traditional portfolio manager bumps up against every single day.
And it all really boils down to this one simple question. Imagine you've got a brilliant manager. They've done all their homework, and they've identified a stock that's, well, just poised to drop. In a traditional fund, how can they actually make money from that insight? The answer you'll see is surprisingly tricky.
This slide really lays out the fundamental imbalance. See, to express a positive view on a stock, a manager can overweight it. They can buy a really significant position. But to express a negative view, their only tool is to underweight it, and the most they can possibly do is just sell their shares, bringing that position down to zero. Their bet against the stock is capped by its starting weight in the index, which is often tiny.
And here's the consequence of that. Because most stocks have a really, really small weight in a big index like the S&P 500, the ability to make a meaningful bet against them by underweighting is, well, it's almost non-existent. The only stocks that are big enough to even allow for a significant underweight position are that handful of giant mega-cap names at the very top. So a manager's negative insights on the other, say, 490-plus stocks, they're effectively useless. They're handcuffed.
Okay, so if traditional investing has these built-in handcuffs, how do we break them? This brings us to the solution, a strategy designed specifically to give managers the tools they need to act on all of their insights, the good, the bad, and the ugly.
And here it is, the active extension, or 120/20 strategy. In a nutshell, it gives the manager the ability to short sell, which is just a way of betting against stocks they think are going to underperform. So they can short up to, say, 20% of the portfolio's value, and the cash they get from doing that is then used to buy an additional 20% of the stocks they're most optimistic about. The final result? You've got 120% in long positions and 20% in short positions.
Now, the mechanics might sound a little complicated, but it's actually a pretty straightforward four-step process. You start with a totally normal 100% long portfolio.
Then you identify your least favorite stocks and you short sell them, up to 20% of the portfolio's value. That sale gives you cash, which you then immediately turn around and use to buy more of your most favorite stocks. Simple as that.
And this is just a crucial point, and it comes right from the source material. The goal here isn't to pile on risk or leverage, no, it's to extend the manager's opportunity set. It's about letting them act on their negative ideas just as powerfully as they act on their positive ones.
You know, this is the really clever part. Because that 20% short position is perfectly balanced by the additional 20% long position, the portfolio's net exposure to the market stays right at 100%. What that means is, from an asset allocation point of view, it behaves a whole lot like a traditional fund. It can fit into the exact same slot in an investor's overall plan.
So, we know the how, but what about the why? Why is this flexibility so valuable? Well, to understand that, we need to look at where managers actually find their edge, their opportunities for outperformance, or, as the pros call it, their alpha.
The research suggests there's this kind of sweet spot in the market. It's not in the mega cap stocks, right? Those are covered by dozens of analysts, so there's not much room for a fresh insight. And it's not really in the tiny microcaps either, where liquidity can be a real problem. No, the prime alpha hunting ground is in that huge swath of mid to large cap stocks. The ones that are liquid enough to trade easily, but not so intensely researched that every single opportunity has been squeezed out.
And this brings us right back to the core problem. A traditional manager can absolutely hunt for winners in this sweet spot, no problem, but they are completely structurally blocked from betting against the losers they find there. Their toolkit is just incomplete. It's kind of like a team that can only play offense, even when they know exactly where the other team's defense is weakest.
Okay, so what's the real, tangible impact of giving a manager this complete toolkit? Let's walk through a model from that Morgan Stanley research paper to see what the numbers might look like. All right, this table shows the potential impact pretty clearly. On the left, you've got your traditional long-only fund. On the right, the active extension portfolio. Just look at the numbers. Portfolio alpha, that's the expected outperformance, it jumps. Tracking error, which is a measure of risk, it goes up, sure, but not by as much. And that alpha/TE ratio, which is basically your bang for your buck, improves significantly. Let's unpack each of these.
First, just look at the sheer increase in opportunities. The manager goes from acting on 25 of their best ideas to 45 of their best ideas. I mean, 20 of those ideas were completely inaccessible before. That's an 80% increase in the manager's ability to actually put their research to work.
Next up, the bottom line. Expected returns. The portfolio's alpha, its potential to beat the market, jumps by a massive 66% in this model. That is a huge potential increase in the value a skilled manager can deliver. But it's not just about higher returns, it's about smarter returns. The risk, which we're measuring by tracking error, it does go up a bit, but nowhere near as much as the alpha. The result is a 24% improvement in that alpha to risk ratio. This is a really crucial measure of efficiency. It shows that the manager is potentially generating more return for each unit of risk they take on.
Okay, so we've seen the mechanics and we've looked at the model. So, what does this all boil down to for an investor? Let's just quickly summarize the key benefits and, just as importantly, the caveats.
You know, this extra flexibility also allows for some real surgical precision. A manager can bet on one company in a sector while betting against its weaker competitor. They can fine-tune their exposure to different industries. And, maybe ironically, they can even use shorting to control risk and stay closer to the overall market's movement, which is known as beta.
But, and this is a really big but, it is absolutely critical to understand that this is not some magic wand. The source material is very clear about this. Short selling is a different beast entirely. It's costly, it requires constant monitoring, and it demands a specialized skill set. It's a powerful tool, for sure, but in the wrong hands, it can be dangerous.
So the crucial point is this: an active extension portfolio isn't about fundamentally changing the nature of an equity investment. It's about taking a manager you already believe in, someone who has skill, and just giving them a more complete toolkit. For the right manager, it can enhance their ability to generate outperformance, all within a controlled and familiar framework.
And that really leaves us with one final core question. You know, active management is all about skill. So if you found a manager who has proven they can spot both the winners and the losers, why on earth would you only let them bet on the winners? It's a question that really could redefine the future of active investing.
So what if the secret to better investing wasn't just about picking winners, but also about betting against the losers? Today, we're diving deep into a really powerful strategy called active extension, and we're going to use some incredible research from Morgan Stanley to figure out when this complex tool actually works, and when it's just an expensive waste of time.
Okay, so here's our game plan for this explainer. First, we're going to start with a classic investor's problem. Then, we'll decode the two numbers that really define success in this world. After that, we'll meet three very different types of managers, give them a powerful new tool, and see who uses it best. And then finally, we'll deliver the verdict. Is this whole strategy just hype, or is it a real game changer?
All right, let's get into it. Section 1, the manager's dilemma. We're going to dig into a fundamental problem that's kind of baked right into the rules of traditional investing.
Okay, picture this. You're a portfolio manager. Your entire job is to have an opinion on companies. You spend hours, days, weeks finding companies you think are just brilliant, the future winners. But what about the other half of your research? The companies you're absolutely convinced are overvalued or poorly run, or just plain heading for a fall? Well, in a traditional long-only portfolio, all those valuable negative insights, they're basically wasted. Sure, you can own a little less of them than the index, but you can't actively bet on your belief that they're going to fail. It's really like trying to win a fight with one hand tied behind your back. And this is really where the two approaches split. In a standard long-only portfolio, you've got $100, you can only buy stuff you like. It's simple, but it's restrictive. But active extension, which you'll often hear called a 30-30 strategy, totally changes the game. Here, a manager can take, say, 30 of their dollars and bet against stocks they think will fail. That's called shorting. And the magic is they can then take the cash from that bet and invest an extra $30 in their absolute favorite stocks. All of a sudden, they're not just picking winners. They're actively using their conviction about the losers to double down on their best ideas. Now, both hands are in the fight.
Okay, so this new strategy sounds pretty great in theory, but how do we actually know if it's working? How do we measure a manager's true skill versus just, plain old luck? Well, it all comes down to two critical numbers.
First up is probably the most famous term in the business, alpha. Put simply, alpha is their skill. It's that unique edge that lets a manager pick stocks that outperform the market. So if the market returns 10% and your manager gets you 12%, that extra 2%, well, that's their alpha. It's the real value they add through all their research and insights. But here's the catch, right? You can't get that alpha for free. To beat the market, you have to be different from the market, and that introduces risk. We measure that risk with something called tracking error, or TEV. I like to think of it as a weirdness score, like how much does a manager's portfolio zig and zag compared to the nice steady line of the market? A high TEV just means they're making bold, risky bets. It's the price they have to pay for a shot at generating that alpha. And this is the core of absolutely everything. You just can't look at skill and risk in isolation. Think about it. A race car driver who wins by a mile, but almost crashes on every single turn. Is he really better than a driver who wins by just a few seconds, but is perfectly in control the whole time? It's not just about the reward. It's about how much danger you courted to get it. That relationship, it's everything. So we measure this with the alpha/TEV ratio, and you should think of this as the ultimate bang for your buck metric. It tells you exactly how much skill, alpha, you're getting for each unit of risk, TEV, that the manager takes on. A higher ratio is always better. It signals a more efficient manager, one who's skillfully turning their ideas into returns without just taking these wild, reckless swings. This ratio, it's going to be our North Star for the rest of this explainer. All right, section 3, and this is where things get really, really interesting because it turns out skill isn't just one simple number. The Morgan Stanley research brilliantly shows that different managers have very different patterns of skill. So let's meet our 3 manager personas. First up, we've got the steady hand. Their best ideas are strong and their skill kind of fades slowly and gracefully. You could say they have a deep bench of good ideas. Then you've got the superstar. Their top picks are absolute home runs. We're talking massive alpha. But their talent is super concentrated. After just a few amazing ideas, their skill just drops off a cliff. And finally, just as a baseline, we have the impossible ideal, this theoretical manager who's equally brilliant at everything. We know this one isn't real, but they're super useful for our experiment. Now, listen up, because this is the absolute key to this whole experiment. The researchers set this up with a brilliant little twist. If you just give each of these managers a standard long-only portfolio to run, they all end up with the exact same performance, 1.75% alpha across the board, On paper, just looking at the final numbers, these three completely different skill sets look identical. Remember that. It's the secret to everything we're about to see. So, what happens when we take these three managers who look identical on the surface and give them that powerful new tool? What happens when we finally let them short stocks? So the process itself is pretty simple. You short a loser, you're betting against a stock you think is going to fail. That move frees up cash. You then immediately use that cash to buy more of a winner, a stock you absolutely love. It's a way to amplify a manager's best ideas and to finally get paid for being right about both the good and the bad companies. Okay, so this tool seems incredibly powerful. It lets managers express way more of their ideas and convictions. But this raises the critical question, right? How much should they actually use it? Is more always better? And boom, here is the big reveal from the research. There is no single right amount of shorting. The perfect strategy is completely dependent on the manager's unique skill pattern. For that fake, impossible, ideal manager, yeah, the math says short as much as you possibly can. But for our real-world managers, the answer is way more interesting, way more nuanced. So let's take our steady hand manager, the one with that deep bench of good ideas. For them, shorting gives a fantastic boost to their risk-adjusted returns, but only up to a point. Once they get into that 40 to 60% shorting range, they've basically hit the sweet spot. If you push them any further, they start having to use their weaker ideas, and the extra risk just isn't worth the reward anymore. But now, look at our superstar, the one with just a few killer home run ideas. For them, more is not better. The benefits of shorting peak incredibly early, at just 10 to 20%. Pushing them to short any more than that actually forces them to use their B-list ideas, which just drags down their overall performance. For the superstar, a little bit of this powerful tool goes a very, very long way. Okay, so far this has all been a fairly clean, academic exercise. But in the real world, there's always a catch. And in this story, the villain is cost. Shorting stocks involves fees and other frictions that just don't exist when you're only buying them. Just watch how quickly the math changes once we add in these real-world costs. Let's stick with our steady hand manager. At a low cost of 50 basis points, that's 0.5%, the optimal strategy is still to short around 40–50%. But look what happens when those costs hit 200 basis points, or a full 2%. All of a sudden, the optimal amount of shorting just plummets. And what's worse, if they short too much, the strategy actually performs worse than the simple portfolio they started with. The villain wins. Costs can completely destroy the benefits of this powerful tool. So after all this analysis, what's the final verdict? Is active extension some revolutionary tool for every single manager out there? Well, the research couldn't be clearer. Active extension is not a magic bullet. Think of it like a three-legged stool. For it to actually work, all three legs have to be solid. First, you need low-cost, efficient shorting. Second, you need disciplined risk control. And third, and this is the most important leg of all, you need a manager who is actually skillful enough to generate alpha in the first place. If any one of those legs is weak, the whole thing just collapses. And that really gets to the heart of it. If a manager's underlying skill is weak, if their alpha is low to begin with, then the complexity and the cost of this strategy are almost guaranteed to overwhelm any potential benefit. It's like putting a supercharger on a lawnmower engine. You're just adding a lot of complexity, noise, and cost without enough fundamental power to make it worthwhile. And this leaves us with a final, really thought-provoking question. The world of finance is just filled with increasingly complex and powerful tools. But what this analysis reminds us is that the effectiveness of any tool isn't really in the tool itself. It all comes down to the skill of the person who's using it. So when you see a strategy like this, maybe the first question shouldn't be how powerful is the tool, but rather how skillful is the manager who's about to pick it up. All right, welcome to The Explainer. Today, we're diving deep into the world of active investment management to unravel a financial mystery that's hiding inside a ton of portfolios. It's called the tracking error gap, and it's a concept that really shows how a fund's actual risk can be completely different from what it looks like on paper. So let's kick things off with a puzzle that probably affects more investors than they realize. You pick a fund, right? It's got dozens, maybe hundreds of stocks, and you think, great, this is safely diversified. But what if I told you there's a hidden layer of risk that the standard financial models just completely miss? What if that fund is taking a much bigger gamble than you or even the manager realizes? Okay, so to get to the bottom of this, we've got to talk about our main clue, tracking error volatility, or TEV. Think of it like this. If a fund's job is to beat the S&P 500, the TEV measures how much its performance wobbles around the S&P 500's. A higher TEV just means the manager is making bigger, bolder, and riskier bets to try and get ahead of that benchmark. And this is where the mystery really kicks in. According to the old-school financial models, a typical fund with, say, 50 different stock picks should have a TEV somewhere between 1.5% to 2%. But in the real world, we often see these same funds with TEVs well over 4%. That's more than double what the theory says is possible. So where is all this extra risk coming from? This difference, this phantom risk, is what we call the tracking error gap. And our mission right now is to put on our detective hats and figure out exactly where this extra, unexplained risk is hiding in plain sight. Okay, so where do we start our investigation? Well, first, we gotta look at the official story, the standard financial theory, and figure out where it all goes wrong. You see, the classic model is built on this one massive and, frankly, totally wrong assumption that every single stock pick is an independent event. It basically pretends that a manager's bet on Apple has zero connection to their bet on Microsoft or on some small biotech firm. It's this perfect, clean, theoretical world where all these risks are completely separate from each other. And that assumption, it completely changes the math. Take a look at this table. It shows the expected TEV based on that flawed model. See how slowly the risk goes up? Even when you have 50 different, supposedly independent bets, the theory says the TEV should barely get over 1.6%. This right here is the heart of the problem.
Which, leads us right to the million-dollar question that the standard model just can't answer. If a 50-stock portfolio should only have a TEV of 1.63%, how in the world are we seeing real funds hit 4%, 5%, or even higher? The math just doesn't add up.
Well, the only way the old model's math could possibly work is if a manager was making these crazy huge concentrated bets. We're talking average position sizes of 6% or more. And while sure a few funds do that, most of the diversified ones we're talking about, no way. Their positions are much smaller, which tells us the model is missing something huge.
So the bottom line, the simple theory is just broken. It doesn't work in the real world. That phantom risk we talked about isn't a ghost. It's just coming from a source this simple theory completely and utterly ignores.
Okay, so if the bets aren't independent, then they have to be connected, right? And that connection, well, that's our prime suspect.
And here it is, the hidden culprit, the missing piece of this entire puzzle, correlation. See, in the real world, stock picks are almost never independent. Managers build portfolios where their bets are related. Maybe they think tech stocks are about to boom, or that banks will do well if interest rates rise. These ideas lead them to pick stocks that don't move in isolation. They move together. And that is the true source of all of that hidden risk.
Okay, now get this. Watch what happens when we add just a tiny bit of correlation to the model. We've added an average correlation, that's the Greek letter rho, of just 0.05. It's a tiny number, but that small change makes the risk explode. For that same 50-stock portfolio, the expected TEV jumps from 1.63% to almost 3%. The risk has nearly doubled, all because of this tiny hidden connection between the stocks.
And I really want to be clear about just how small this number is. A correlation of 0.05 means the stocks are only slightly related. It's like a whisper of a connection. But when you have 50 of these whispers all happening at the same time, they amplify each other and create a roar of unexpected risk. That's the power of compounding correlation.
All right, so if a tiny bit of correlation makes risks skyrocket, let's just flip this whole thing around to solve our mystery. How much correlation do we actually need to explain that 4% TEV we see all the time in the real world?
And boom, here's the answer. To get to that real-world 4% TEV, you only need an implicit correlation of about 0.10 among the fund's bets. That's it. Mystery solved. The tracking error gap, that so-called phantom risk, was never a phantom at all. It was just the powerful and often overlooked effect of stocks moving together.
So we found our main culprit, right? Correlation. But like in any good mystery, the main culprit rarely acts alone. It has accomplices, specific investment themes that give it all its power. And understanding these is the key to really knowing what a fund manager is up to.
A high TEV is almost always powered by two of these accomplices. First up, you've got factor effects. Think of this as the reason for the correlation. It's when a manager leans the portfolio towards a specific trait, like one industry or value stocks or small cap stocks. The second is beta gaps. Beta just measures how much a stock moves with the overall market. So a beta gap means the manager is basically making a bet on which way the whole market is going to go. And here's what's absolutely crucial for you to understand. Is this intentional? Is the manager deliberately taking on these risks as part of a clear, well-thought-out strategy? Or are these risks just an accident, a byproduct of how they pick stocks? Are they playing a calculated game of chess, or are they just wandering through a field picking flowers they like? The answer tells you everything about whether you can trust their process.
Okay, we've cracked the case. So now what does all this actually mean for you as an investor? How do you use this knowledge?
The big takeaway here is this. From now on, when you see a fund with a high TEV, don't just see it as a red flag for high risk. You should see it as a signal, like a lighthouse beam cutting through the fog, telling you to start asking some smarter questions about how that fund is really being managed. And this is where you can turn that number into a really powerful tool. Start asking questions like these. Is this high risk coming from a big bet on the market direction? Does the manager even know they're heavily tilted towards, say, the energy sector? Is that an intentional strategy or just an accident? And maybe most importantly, could they get better returns? That's alpha, the extra performance you pay them for, if they actually paid attention to and managed these hidden risks. And really, that's the bottom line. A tracking error isn't just a number on a page. It's not an answer. It's a question. It's an invitation to look deeper and to really understand the true nature of the bets being made with your money.
So let's wrap this all up. The simple models you might see, they're often just wrong. Real-world investment risk comes from these hidden connections, from correlation and these big factor bets. Understanding the tracking error gap gives you the tool to finally see this hidden risk, and that helps you become a much more informed investor. The real question is, now that you know where to look, are you going to start asking the right questions?
All right, today we're diving deep into some really fascinating research from Morgan Stanley that uncovers something that could have a huge impact on investment returns. We're talking about active extension strategies and a little thing called correlation.
So let me just start with a question for you. What if I told you there's this silent force kind of lurking in your portfolio, a hidden factor that's quietly working against even the best stock picks, adding risk and eating away at returns, all while flying completely under the radar? Sounds a little dramatic, I know, but it's a very, very real challenge in active management.
Okay, so here's our game plan. First, we're going to uncover this hidden risk. Then we'll see why traditional long-only portfolios are really feeling the strain. After that, we'll bring in our solution, the active extension, and reveal the negative correlation secret that makes it so powerful. From there, we'll see exactly how it can boost your information ratio. And finally, we'll talk about what this all means for the future of alpha.
All right, first things first, we have to identify the enemy. And in the world of active investing, this is a powerful force that too often just goes completely unmanaged, quietly sabotaging performance from the inside.
You know the deal, right? For any active manager, the entire game is about generating alpha. It's that bit of return you get above and beyond the market benchmark. It's supposed to be the proof of skill, the reason you pay fees. Simple as that. More alpha is better.
And this hidden risk we're talking about, well, it all comes down to one word: correlation. It's just a way of measuring how much your stocks tend to move together. And here's the kicker. Even really small, seemingly harmless positive correlations, where your best ideas all just kind of drift up and down together, can bundle up and create a shocking amount of hidden risk.
The best way to picture this is to think about being on an airplane. The pilot has a great flight plan. That's your alpha strategy. But this correlation, it's like unexpected turbulence. It just makes the whole ride choppy and way riskier than it needs to be, even though you're still pointed toward the right destination.
So let's see how this actually plays out. We're going to take a look at a standard long-only portfolio, the kind most active managers run, and see exactly how this hidden risk starts to cause some real problems.
I mean, in a fantasy land, right? In a perfect theoretical world, every single stock a manager picks would be a totally independent bet. Its success or failure wouldn't have anything to do with any other stock in the portfolio. In that world, risk would be super low. But, we don't live there.
And this slide, wow, this is where it gets real.
This chart measures the portfolio's active risk, which is often called tracking error volatility, or TEV. Now, if there was zero correlation, the risk sits at 2%. But then you introduce just a tiny, modest correlation of 0.10. That's it, and look what happens. The risk literally doubles to 4%. That is a massive leap from such a small, innocent-looking number.
And this brings us to a really crucial metric, the information ratio, or IR. This is pretty much the gold standard for measuring how efficient a manager is. It asks a simple question. For every unit of risk you take on, how much alpha are you actually giving me? So a high IR is exactly what you want to see.
And here's the punchline. All that extra risk we just saw, it absolutely hammers the portfolio's efficiency. With a pretty realistic correlation of just 0.05, our long-only portfolio ends up with an information ratio of just 0.51. And frankly, as the research points out, that's a level that a lot of investors would look at and say, no thanks. The portfolio just isn't working hard enough.
So, okay, we have a real problem. Correlation is this invisible drag on performance. But this is where a more advanced strategy comes into play. It's called an active extension, and it gives managers a brand new and really powerful tool to fight back.
So what exactly is an active extension strategy, like a 120/20 fund? Well, it's pretty clever. The manager finds stocks they think are going to go down, and they short sell them, let's say for 20% of the portfolio's value. That short sale gives them cash, which they then use to buy 20% more of the stocks they absolutely love. So now they're 120% long and 20% short, but they're still 100% net invested in the market.
But here is the secret. The real magic of this whole strategy isn't just about getting more money to put into your best ideas. No, the true power is how you can use that short side of the portfolio to actively cancel out the risk from the long side. This is where it gets really, really smart.
Hey, remember that turbulence analogy from earlier? Well, think of this strategy as putting on a pair of active noise-canceling headphones for your portfolio. The short positions are specifically chosen to create an anti-noise signal that literally cancels out that unwanted risk, that turbulence, coming from your long stocks.
And this slide just shows you the raw power of that idea in black and white. On the left, if there's no relationship between your long and short picks, the portfolio risk is 4.75. But on the right, by carefully picking shorts that have a slight negative correlation to your longs, meaning they tend to zig when your other stocks zag, the manager brings the overall portfolio risk all the way down to 3.97. You are actively engineering risk out of the portfolio.
And hey, don't just take my word for it. The researchers at Morgan Stanley said it themselves. They said the opportunity for offsetting negative correlations can act as a major TEV reducing factor. This isn't just a nice little side benefit. It's a core, powerful feature of doing this right.
So, the billion-dollar question. What's the actual payoff? Yeah, we've lowered the risk, that's great, but how does that translate into overall efficiency? Let's take a look at the before and after picture for that all-important information ratio. First, a quick reminder of where we started. Our standard, long-only portfolio was just kind of stuck, bogged down by that hidden correlation and operating with an information ratio of just 0.51. You know, it's not awful, but it's definitely not great either.
And now, check out the transformation. By using that active extension strategy and intelligently using the short side to create that tiny negative 0.05 negative correlation, bam, the portfolio's peak information ratio jumps to 0.90. That is a massive 76% boost in efficiency. You are getting so much more bang for your risk buck.
This table really just drives the point home. It shows a really clear relationship. If you don't create any offset with your shorts, you get a tiny improvement. But as you get better and better at creating that negative correlation, going from moderate to strong, that information ratio just climbs and climbs. The smarter you are about engineering this offset, the more efficient your portfolio becomes.
So what does this all mean for the big picture, for the future of active management? Well, it really suggests that maybe there's a big shift in where managers should be focusing their energy.
So, let's just wrap this all up. What this research shows us is that modern active management isn't just about finding winning stocks anymore. It's just as much about smart portfolio construction and risk engineering. Strategies like active extensions give managers a serious weapon to fight back against that hidden drag of correlation. And when you do that, you can seriously improve your efficiency and squeeze way more alpha out of every unit of risk you take. The bottom line? It leads to smarter, more robust, and just plain better portfolios.
And that leaves us with one final, big thought to chew on. In a world where it feels like everything is getting more and more interconnected, where correlations are rising, maybe the real skill, the new frontier for generating alpha, isn't just about picking the right stocks.
but about engineering the right portfolio. Something to think about. Thanks for tuning in.
Hey, welcome. Today, we're going to dive into a really powerful investment strategy, one that tries to break through a performance ceiling that honestly frustrates a lot of active managers. We're going to be looking at some compelling research from Morgan Stanley to see how the very rules most investors play by might be holding them back, and how a completely different approach could unlock some serious potential. So, let's get right into it. Okay, so here's the game plan. We're going to start by looking at a major limitation in traditional investing called the long-only constraint and see how it creates this kind of hidden performance wall. Then we'll introduce the solution, a strategy called active extension. We're going to unpack how it can generate new returns and also make your risk-taking more efficient. And finally, we'll zoom out to see the real-world impact this can have on an entire portfolio. All right, first things first, let's set the stage by talking about the world most investors live and operate in. It's a world that has one very specific and very important rule. And that rule? It's the long-only constraint. All it means is that you can only make money when things go up. You find a company you like, you buy the stock, and you hope it appreciates. Simple enough. But what about a company you think is heading for trouble? Well, your only real option is to just not buy it, or sell it if you already own it. Think about that. You have all this valuable negative insight, but there's no way to directly profit from it. Half of your research is basically left on the cutting room floor. Now, in this long-only world, how do we keep score? Well, we use two main stats. On one side, you have alpha. That's the reward. It's the extra return a manager gets on top of the market benchmark. It's a pure measure of their skill. Then on the other side, you have tracking error volatility, or TEV. Just think of TEV as the risk score. It measures how much a manager is straying from the benchmark to make those active bets. The whole game really is to get the most alpha you possibly can for every unit of risk, or TEV, that you take on. Okay, but this is exactly where things get tricky for the long-only manager. As they try to generate more and more alpha by adding their best ideas, they often run smack into an invisible barrier, a point where they just stop getting rewarded for the extra risk. And so this brings us to a really critical question. If a manager has a ton of great stock picks, does adding more and more of them to the portfolio always improve that all-important ratio of reward to risk? I mean, your gut might say yes, but the data, it tells a very different story. So here's the problem. Stocks don't live in a vacuum. They're connected by industry, by sector, by what the economy's doing. This connection is called correlation. And what the research shows is that as a long-only manager adds more of their best ideas, even a tiny bit of positive correlation, meaning the stocks tend to move together, causes the portfolio's overall risk, the TEV, to grow just as fast as the potential reward, the alpha. So the manager is taking on more risk, but their risk-adjusted return, it's flat. They're running faster just to stay in the same place. And, this quote from the research just hits the nail on the head. A portfolio's risk is incredibly sensitive to these hidden relationships between stocks. You might think you're adding diversification with every new stock, but if they all kind of move together, even a little bit, your active risk can just balloon without you realizing it. Want to see how crazy this gets? Let's put a number on it. A correlation of just 0.05. I mean, that's a super weak, almost unnoticeable relationship between two stocks. But that tiny connection can cause the portfolio's active risk to jump by a staggering 45%. That is a huge, unseen drag on performance. This is that invisible wall. So how do you break through it? Okay, so how do you smash through that wall? Well, this is where a really innovative strategy comes into play. It's called active extension, and it basically gives the manager a whole new toolkit to work with. The easiest way to get this is with a horse racing analogy. Think about it. A traditional long-only manager can only bet on the horses they think are going to win, place, or show. But an active extension manager, they get to do something else. They can also bet on the horses they're pretty sure are going to finish dead last. They get to act on their negative views, too. So, in Wall Street terms, that's what an active extension, or AE, portfolio does. The manager finds stocks they think will do poorly and shorts them. This move generates cash. They then take that cash and use it to double down on their highest conviction long ideas, the stocks they feel most confident about. It lets them amplify their best positive ideas, and they fund it by cashing in on their best negative ideas. It's brilliant. So let's walk through the most common playbook here, the 120/20 strategy. It's pretty straightforward, just 4 steps. 1, you find stocks you think are going to underperform. 2, you short sell an amount equal to 20% of your portfolio's value. 3, that generates cash, and 4, you reinvest that 20% right back into your absolute favorite long picks. So what's the result? You end up with 120% exposure to your longs and 20% to your shorts, but because they balance out, you still have 100% net exposure to the market, just like a regular old fund. Okay, so we've got these new tools, but how does this freedom, to go long and short, actually translate into better performance? Let's get into the nuts and bolts. Right off the bat, the biggest game changer is that your short positions become a brand new source of alpha. If you correctly pick stocks that go down in value, those short positions make a profit. This is a massive shift. Shorting isn't just a way to raise money. It becomes an entirely new engine for generating returns, one that's totally off limits to the traditional manager. Okay, that sounds awesome, but it brings up the million-dollar question, doesn't it? We've added more positions, both long and short. Does this actually improve that critical alpha to TEV ratio? Are we really getting a better bang for our risk buck here? And the answer is a huge, resounding yes. And this, right here, is the secret sauce. A skilled manager can now pair their long positions with short positions that are negatively correlated, which just means they tend to move in opposite directions. This lets them cancel out unproductive risk, the broad market swings that affect all stocks. By doing this, they can isolate the specific company-level stuff they actually want to bet on, making the entire portfolio much, much more efficient. And wow, this chart just lays it all out perfectly. Check this out. See the bar on the far left? A typical long-only portfolio might have a risk-reward ratio of 0.54. Now, move to the middle. Just by switching to a 12-20 structure, that ratio jumps up to 0.63. But here's the magic. Look at the bar on the right. When the manager creates even a tiny negative correlation between their longs and shorts, that ratio skyrockets to 0.92. That is a massive leap in efficiency. So that 0.92, let that sink in for a second. That represents a potential 70% improvement in risk-adjusted returns compared to the traditional long-only approach. It's the mathematical proof that giving a skilled manager the full toolkit, the ability to go both long and short, can lead to dramatically better results. Okay, that's really impressive in theory, but what does this mean for your actual portfolio? Let's zoom out and look at the big picture. Does all this shorting and leveraging make your overall fund wildly more volatile? This table tells the whole story, so let's look at a standard 60-40 portfolio. Just compare the active long-only line to the AE with offset line. By swapping in the active extension strategy, the expected return jumps up pretty nicely, from about 6.9% to 7.3%. But now look at the volatility column. It barely moves. It goes from 11.36% to just 11.40%. So what's the bottom line here? You're getting a lot more return for basically the same amount of overall risk. That's a trade you'd take all day long. Now look, this isn't some kind of magic wand. For this to work, a few things have to be true. The manager needs a really solid process for finding not just winners, but losers too. They need to have incredible risk discipline. They have to be really good at sniffing out and using those negative correlations. And the whole thing has to be done in a cost-efficient way, because fees can definitely eat into your returns. And this last quote from the research really ties it all together perfectly. Because these strategies keep that net market exposure at 100%, they don't really change the overall riskiness of a big diversified fund. So the only question that truly matters is, can the manager actually deliver? Can their process reliably find those winning longs and those losing shorts to generate that extra alpha? And that really brings us to the final thought I want to leave you with. As the research shows, the risk profile of your portfolio doesn't have to change that much. The real shift is in the manager's toolkit. Active extension unlocks the other half of their brain, the part that can act on negative research. So the question is this: if you could cash in on your predictions about failure just as easily as your predictions about success, how would that fundamentally change the way you think about investing? Welcome to The Explainer. Today, we're diving into some really fascinating research from Morgan Stanley to tackle a huge question for investors. When it comes to getting the best returns, how complicated does your strategy really need to be? Is more complex always better? Okay, so here's what we're going to cover. We'll start with the basic challenge every investor is up against, this constant hunt for what's called alpha. Then we'll unpack a pretty powerful tool called active extension and dive into a big debate about the best way to use it. And stick around, because the final verdict is, well, it's not what you'd expect. All right, so for any active fund manager, there is one big goal, right? It's the whole reason they exist, to consistently, reliably do better than the overall market. So how do they do that? I mean, what's the secret sauce? Well, it all boils down to one single, super important concept that really defines success in this game. And that concept is alpha. You've probably heard the term. It's basically the magic ingredient. Alpha is what separates a truly skilled manager from someone who's just riding the market's waves. Think of it this way. It's the proof, in numbers, that they actually know what they're doing, that they can find the winners. But here's the thing with the old-school traditional way of investing. It's kind of one-sided. Managers can buy stocks they think are going to go to the moon, sure, but what about the stocks they're convinced are going to tank? They're basically stuck on the sidelines, unable to profit from being right about the losers. So you can see the problem, right? To get around this, a whole new kind of strategy was cooked up, one that gives managers a lot more flexibility and, frankly, a lot more firepower. Enter the active extension strategy. This is a real game changer because it finally lets managers play both offense and defense. They can bet against stocks they think are duds by shorting them, and here's the kicker. They can take the cash they make from those short sales and pump it right back into the stocks they're really excited about. And you know what? The way this works is actually pretty simple. As the Morgan Stanley research points out, this isn't some crazy, super complex hedge fund thing. It's really just a straightforward extension of what managers were already doing, giving them a bigger, better toolkit to work with. Okay, so now we've got this powerful new tool. But that brings up a really important question, maybe the most important question. How do you actually use it? What's the smartest way to place your bets? And it really comes down to two camps. On one side, you've got the simple approach, fixed weighting. Just give all your good ideas the same amount of money. Easy. On the other side, you've got the complex, theoretically optimal approach, proportional weighting. This one says, hey, bet the farm on your absolute best ideas and give less to the others. Now, on paper, that second one sounds smarter, right? But does it actually work out that way in the real world? And this chart right here shows you exactly what we're talking about. See that flat line for the fixed weight? Super simple, every idea gets the same love. But look at those other curves. They are all about going big on a few top picks, and then the interest just drops off a cliff. Big bets right up front. Okay, but there's a catch. There's this little hidden gremlin in the system that can mess everything up, no matter which strategy you pick. And that gremlin is called correlation. Now, to really get what correlation does, we got to talk about risk. And the way we measure that is with something called tracking error volatility, or TEV. Don't let the name scare you. Just think of it like this. It's a number that tells you how bumpy the ride is going to be compared to the overall market. And whoa, just look at what happens here. This chart is wild. Even a tiny, tiny bit of correlation, we're talking just 0.05, sends your performance through the floor. See, when all your different bets start moving in the same direction, you're not actually diversified. Your risk goes way up, and your return for taking that risk, well, it just craters. But this is where active extension strategies have a secret weapon. A really sharp manager can actually use their short positions to cancel out some of that bad risk from their long positions. It's like having a built-in hedge, making the whole portfolio way more efficient. All right, so this is it, the big showdown, simple versus complex. When you factor in the real world with all its messy correlation, does all that extra brain power for the optimal strategy actually make a difference? Let's check the numbers. Okay, I want you to zero in on that last column, the alpha to T of V ratio. That's the money shot, right? That's your bang for your buck. And after all that fancy math that goes into the optimal strategy, what's the difference? It's pretty underwhelming. Seriously, that's it, 0.02. The big advantage you get from all that extra complexity is so small you can barely see it. It's practically a rounding error. All that effort for a barely measurable improvement. And you don't have to take my word for it. The researchers at Morgan Stanley said it themselves. For most regular risk-managed funds, the kind most of us invest in, that simple fixed weighting approach, it's perfectly fine. It gets the job done. So, after all that, what's the bottom line? What are we supposed to take away from this whole analysis? At the end of the day, it's pretty clear. The active extension strategy itself,
super valuable. But this whole argument about simple versus complex weighting, for most investors, it's just noise. The real magic, the thing that actually generates alpha, isn't some complicated formula. It's the manager's skill in picking the right stocks to buy and the right stocks to short. Period.
Because this is where the real power of active extension lies. It lets you tap into a whole new world of opportunities by shorting. It lets you use that money to go even bigger on your best ideas. And it helps you slash unproductive risk. And guess what? All of that is true whether your weighting model is simple or insanely complex. So I'll leave you with this question. The next time you're looking at a fund and you hear all about its super sophisticated, optimal strategy, it's worth taking a step back and asking yourself, is all that complexity actually adding value, or is it just adding noise? Hey everyone, and welcome. We've all had this rule drilled into our heads: don't put all your eggs in one basket, right? It's the absolute golden rule of investing: diversify, diversify, diversify. But what if the pros, the people who are paid millions to find the very best investments, are actually breaking that rule? Today we're going to dive deep into the data and ask a really provocative question. Is concentrating your bets, not spreading them, the real secret to winning? All right, so let's start with the textbook theory. It's actually pretty simple. If you just assume that all your investment ideas have more or less the same potential, well, then the smartest thing you can do is spread your money out as far and wide as you can. This is supposed to give you the best possible return for the lowest amount of risk. It's clean, it's mathematical, and it's basically the foundation of modern portfolio theory. But, and this is the big question, isn't it? Do the people who actually manage billions of dollars really follow this rule? Is there a huge gap between what the classroom says and what actually happens on a real-life trading floor? Well, that's the puzzle we're going to try to piece together today. Now, to really get into this and challenge the dogma, we first need to get on the same page. We need to speak the language of professional investors. There are three really important terms they use all the time to measure their success: alpha, tracking error, and the information ratio. Let's break them down one by one. First up, we've got alpha. You've probably heard this one. Simply put, alpha is your edge. It's the extra return you get above and beyond the market. So if the S&P 500 goes up 10% and your portfolio goes up 12%, that extra 2%, that's your alpha. It's the direct result of a manager making smart, active decisions. It's the reward for being right. Okay, next up is tracking error, or TE for short. Now, if alpha is the reward for being different from the market, then tracking error is the risk you take on by being different. It measures just how much your portfolio's performance zigzags away from the benchmark. A really low tracking error means you're basically hugging the index. A high tracking error, though, means you're making some big bets, and your performance could be wildly different, for better or for worse. And that brings us to the metric that ties it all together: the information ratio, or IR. You get it by taking your alpha and dividing it by your tracking error. It answers a really simple but powerful question. How much extra return am I getting for every unit of risk I'm taking on? You can think of it as the ultimate measure of a manager's skill and efficiency. A high IR means you're getting a lot of bang for your buck. So let's circle back to that perfect theoretical world for a second. If you make the big assumption that every single stock you pick has the exact same potential to generate alpha, we call this constant alpha, then the math is super straightforward. The best way to get the highest information ratio is to get your tracking error as low as possible. And how do you do that? You guessed it. You spread your bets as widely and as evenly as you can. In this world, maximum diversification is the undisputed champ. So, yeah, that's the theory. It's neat, it's tidy. But what actually happens out there in the messy real world? Let's pull back the curtain and look at what the data from professional fund managers actually tells us. Are they following the textbook? And right away, the data shows us something really fascinating. When we look at the single biggest active bet a fund manager makes, what we call their maximum active weight, a super clear pattern emerges. The vast majority of them concentrate that biggest bet into a 1% to 4% position. Almost nobody is as diversified as that pure theory says they should be. This is our first major clue that the pros are playing a totally different game. And it's not just their top position either. When you look at the whole portfolio, you see this beautiful curve. They place their biggest bet, about 2.7% on average, on their number one highest conviction idea. But by the time they get to their 25th best idea, the weight is already down to just 1%. And by the 50th position, it's basically zero. This is what we call an exponential decline. They are very, very clearly not treating all of their ideas as equals. So, what does this behavior really tell us? I mean, why would managers across the board systematically place bigger bets on their top ideas? Well, it implies something really fundamental about what they believe. It tells us that in their minds, not all alphas are created equal. And this is the first huge wrinkle in our simple theory. Instead of that constant alpha model where every idea is just as good as the next, real managers seem to operate on what we'll call a declining alpha model. They believe their best ideas, their top 5 or 10 picks, are going to generate the most alpha. And by the time they get down to their 50th best idea, their conviction and their expected return has dropped off a cliff. And here's the crucial takeaway from that. If you believe in declining alphas, if you really think your best ideas are truly better than the rest, then concentrating your money in those top ideas is the only logical way to maximize your whole portfolio's expected alpha. You are deliberately and strategically overweighting the positions you think will pack the biggest punch. But hang on, that's only half of the story. There's a second real-world factor that throws a wrench into that simple diversification model, and that factor is correlation. See, in the real world, stocks don't move around in a vacuum. Their fates are often tied together. You see, in our simple model, we kind of assume every stock is independent, but in reality, stocks in the same industry or in the same economy, they tend to move together. This is called positive correlation. And what this does to our risk equation is pretty profound. It means the diversification benefit you get from adding just one more stock isn't as big as you'd think. But it also means the risk penalty, that increase in tracking error you get for concentrating, is way less severe than the simple theory predicts. The risk curve just flattens out. Okay, this is it. This is where everything we've talked about comes together. On one hand, we have managers who believe in declining alphas, so they concentrate their portfolios to boost returns. And on the other hand, we have correlation, which makes the risk of doing that way less scary. When you combine these two powerful real-world factors, the entire picture of what's optimal gets completely turned on its head. This slide right here shows the core revelation. Look at the left side. Under the old theory, the more you concentrate, the worse your risk-adjusted return gets. Period. Diversification is always the answer. But now, look at the chart on the right, which shows how managers actually think. With declining alpha, the information ratio goes up, hits a peak, and then stays almost completely flat. This is a total game changer. It means you can concentrate your bets, aim for much, much higher alpha, and take on almost no extra penalty from a risk efficiency standpoint. So, where's the sweet spot? Well, in that simple, theoretical world where your investments aren't correlated, the math tells us that the absolute perfect risk-adjusted return, the optimal information ratio, is achieved when your biggest single bet is 2.7% of your portfolio. Now, does that number sound familiar? It should. That's almost exactly what the average fund manager actually does. But watch what happens once we factor in real-world correlation, the fact that stocks tend to move together. The optimal strategy changes dramatically. The analysis shows that the highest possible information ratio is now achieved with a much more concentrated portfolio, where the biggest position is way up at 4.8%. All of a sudden, taking bigger, more concentrated bets becomes the most efficient strategy you can have. So let's just walk along this new frontier of possibilities. A fund sponsor could choose broad diversification, sure, but they'd be knowingly accepting low risk and low alpha. They could move to that 2.7% sweet spot to get the absolute best risk-adjusted return. Or, and this is the key, they could decide to push even further into high concentration. Their information ratio might dip just a tiny bit, but they would capture the highest possible alpha. And for a lot of investors, that's a trade-off that's absolutely worth making. So what does this all mean? It means we really need to reframe how we think about concentration. It's not necessarily a mistake or a sign of being reckless. For an active manager who has really high conviction in their best ideas, concentration is actually a powerful and incredibly logical tool to maximize their returns. All right, let's put it all together. What have we learned on this journey? First, if you truly believe your best ideas are better than the rest, concentrating your bets is the most logical way to boost your overall return. Second, because stocks are correlated in the real world, the risk of concentrating isn't nearly as scary as the old theory made it seem. Which leads to our third point. Even a highly focused portfolio can be incredibly efficient from a risk-adjusted point of view. And that leaves every investor with a fundamental choice. Are you playing to maximize your efficiency, or are you playing to maximize your alpha? You know, if there's one single number to take away from all of this, it's 2.7%. In our model, that was the absolute perfect position size to maximize risk-adjusted returns in that theoretical world. And what's so incredible about that is that it's also the median size of the biggest bet made by real-world fund managers. This is the exact point where theory and practice collide, and it suggests that the best managers have been acting on this powerful intuition all along. So, maybe we've been looking at this whole thing backwards. Perhaps the goal was never diversification for its own sake. The goal is, and always has been, to generate returns. Diversification is just one tool to manage the risk along the way. So the real question this leaves us with is a lot more personal. It's this: how much conviction do you really have in your own best ideas, and are you willing to bet accordingly?
All right, welcome. Today, we are diving into a really powerful idea from a Morgan Stanley research paper. It tackles a huge problem for investors. How do you get more of your absolute best ideas into a portfolio without just cranking up the risk? Well, we're going to break down a surprisingly simple strategy that uses what are called generic shorts to do exactly that. It helps boost your returns for every single unit of risk you take on. Honestly, it's a really elegant solution.
So here's the game plan. First, we're going to set the stage with the core problem, what we're calling the manager's dilemma. Then we'll introduce this kind of counterintuitive solution and actually put it to the test with Morgan Stanley's data. From there, we'll dig into the risk-return numbers, see how to apply this with a smarter blended strategy, and then we'll wrap up with the one key idea that you should really take away from all this.
Okay, so, every active manager is on this constant quest for alpha. That's the holy grail, right? Beating the market. They have these incredibly powerful tools to find winning stocks. But even the best stock pickers out there run into a pretty fundamental problem. There just aren't as many great ideas on the other side of the trade.
And that, right there, is the core question we're tackling. I mean, if you are great at picking winners, you naturally want to bet big on them. One way to do that is to also bet against stocks you think are going to lose. But what happens when you've got way more great buy ideas than you have high-conviction sell ideas? So where do you get the cash to fund those big bets?
And that's where these strategies, like the 130-30, come into play. The idea itself is pretty simple. You short sell stocks that are worth, say, 30% of your portfolio. Then you take that cash and you pour it into your absolute favorite long positions. This brings your total long exposure up to 130%. Your net exposure is still 100%, but you've basically supercharged your ability to bet on your winners. But here's the catch, right? It all hinges on finding 30% worth of great stocks to short. So this whole dilemma, it leads to a really fascinating and honestly a deeply counterintuitive solution. Instead of searching high and low for yet another brilliant high alpha short idea, what if the best move you could make was to use something kind of boring?
See, the real solution here isn't about chasing more alpha on the short side. It's actually the complete opposite. It's about using tools that are built from the ground up to have zero alpha.
And that's where generic investments come in. These are your broad market ETFs, your index funds. Their job isn't to generate alpha. Their job is to just be the market. Like the paper says, they have zero alpha. They're designed to be perfectly average. So you got to ask, why on earth would an active manager whose entire job is to beat the average want to touch these things?
Okay, and this is where the strategic genius of this whole thing really shines. An active short, that's like a scalpel. It's a precise, research-heavy bet designed to generate alpha. But a generic short, that's more like a counterweight. Its first job is super simple: generate cash so you can buy more of your favorite stocks. But its second and far more important job is to balance the portfolio by neutralizing risks you don't even want. Think of it this way. If your long portfolio is heavily tilted towards, say, tech stocks, shorting a broad market index can help cancel out some of that concentrated tech risk. It's a hedge.
All right, so that all sounds great in theory, right? But does it actually work in the real world? Let's turn to the model Morgan Stanley built to see how these two different approaches really stack up.
Okay, so first we need a baseline. The paper calls it long reinvestment only, or LRO. This is the simple version. You short something just to get the cash, and then you plow that cash right back into your existing long picks proportionally. As you'd expect, you're basically just turning up the volume on everything. You get more potential alpha, sure, but you also crank up the risk by the exact same amount.
Now, if you're just looking at pure raw alpha, that baseline LRO strategy looks like the winner. As you can see, it delivers the highest raw return.
The generic strategies are just a tiny bit behind because of some minor costs. If this was the only chart you looked at, you'd think the choice was obvious. But, and this is a huge but, that's only half the story.
Because this is the other half of the story. This chart shows tracking error, which is basically a measure of how much your portfolio wobbles compared to the market. Just look at that LRO line, that wobble, that tracking error, it just skyrockets. You're just amplifying all your existing bets. But look at the generic offset strategy. It is remarkably stable. By strategically picking a generic short that zigzags when your main portfolio zigs, you are actively canceling out a huge chunk of that unproductive risk.
So what happens when we put these two pieces together, alpha and risk? Well, this chart shows the information ratio, which is really your bang for your buck, your alpha divided by that portfolio wobble. With the simple LRO strategy, that line is totally flat. Sure, you get more alpha, but you take on exactly that much more risk. There's no free lunch there. But just look at the generic offset. The ratio soars. You are generating far more return for every single unit of risk you take. This, right here, is where the magic happens.
And look, we're not talking about some tiny little improvement here. As the researchers state plainly in the paper, using this approach can result in a 20 to 30% improvement in your information ratio. For any active manager, a jump like that, that's absolutely massive.
Okay, let's get even more practical and drill down on these numbers. Let's see how this whole thing plays out in a real-world scenario, where managers have to operate within very strict risk limits.
This table really lays it all out, nice and clear. Let's say your fund has a hard risk limit, a tracking error no higher than 5%. Now, with that simple LRO strategy, if you want to chase that higher 2.9% alpha by going to a 50% short, look what happens. Your risk blows past the limit to 5.9%. No, can't do it. Your risk manager would shut that down in a second. But with the generic offset, you can get a really strong 2.7% alpha and your risk stays comfortably at 4.2%. It's the only strategy that lets you boost returns without breaking your own rules.
So, the data is pretty darn clear. But this doesn't mean you should abandon active short selling altogether. Not at all. The paper proposes a smarter, blended approach. It's a really smart idea they call generic completions.
And the process here, it's just so logical it makes perfect sense. You don't abandon your active shorts, you lead with them. Step 1, you deploy all of your best, highest conviction short ideas. But then, when those run out, you still need cash to fund your best long ideas. That's the gap. And then you complete your short portfolio using generics, raising the final cash you need in the most risk-efficient way possible.
And honestly, this is the real masterstroke of the whole paper. The model shows something pretty incredible. A blended portfolio, say 20% active shorts plus 30% generic shorts, can deliver more alpha than a 50% all-active short portfolio for the exact same amount of risk. Just let that sink in for a second. By strategically adding a zero alpha tool, you can actually improve your final alpha. You get the best of both worlds, targeted alpha from your active picks, and this powerful risk reduction from the generics.
Okay, so we've gone through the problem, the data, the strategy. What's the one big thing you need to walk away with from all this?
The big idea is this. Using simple, boring, generic shorts isn't some kind of compromise. It's a powerful strategic tool. It's a way to fund your best ideas while simultaneously hedging away unwanted risks, which ultimately lets you build a more aggressive, higher alpha portfolio that is somehow, counterintuitively, also safer.
And all this leaves us with one final thought, one last question to chew on. In a world that is constantly searching for the next complex edge, maybe the most powerful move isn't another complicated trade, but just a simple, elegant offset.
For as long as any of us have been investing, we've had one rule just drilled into our heads. Diversify, right? Spread your bets, lower your risk. But what if I told you that for some of the world's most sophisticated investors, diversification isn't really working the way we all think it is? Let's dive in and break down what's actually going on.
Okay, so let's start by looking at two very different portfolios. Over on the left, you've got the old classic, the simple 60-40 split. Just US stocks and US bonds. Easy. But on the right, you've got a much more complex modern portfolio. It's spreading its money across a dozen different asset classes. International stocks, emerging markets, private equity, you name it.
So here's the big question. Which one do you think is riskier? Now your gut, and pretty much every finance textbook, is going to tell you it's the one on the right, the complex one. It's way more diversified, so it should be way less risky, right? Well, get ready for a pretty big surprise.
So researchers at Morgan Stanley decided to look under the hood of a whole range of big institutional funds, from the super simple ones to the incredibly complex. And what they found was, well, it was just plain weird. Instead of seeing a big spread of different risk profiles, they found this bizarre clustering.
This all comes down to a concept called beta. Just think of it as a portfolio's sensitivity to the US stock market. A beta of 1 means it moves perfectly in line with the market. Now, what the researchers found was absolutely shocking. Despite looking wildly different on paper, almost all of these institutional portfolios had a beta that was stuck between 0.55 and 0.65, an incredibly narrow window.
And it didn't stop there. When they looked at total volatility, the overall measure of how much a portfolio's value bounces around, it was also crammed into this tiny range of just 10 to 11.5%. It's like everyone was cooking a completely unique recipe, but they all ended up with the exact same dish. And this chart right here, it just shows you what that looks like visually. That curved line is the famous efficient frontier. It's the best possible return you can theoretically get for any level of risk. And look at that. You can see all those different portfolios, from the simple 60-40 to the most complex ones, all bunched up together in that tiny little neighborhood. Different roads all leading to the same place.
So what in the world is going on here? How is this possible? Well, the culprit is something called the funding mix. See, when a manager decides to buy a new asset, like, say, private equity, they've got to sell something to raise the cash. And what do they usually sell? A little bit of stocks, a little bit of bonds, basically a medium risk mix. So they're often just swapping one medium risk asset for another, and the portfolio's total risk, well, it barely moves an inch. Okay, so this whole discovery, it forces us to completely redefine the building blocks of a portfolio. We need a new way of looking at this, a new lens to see what's really driving risk and return. And that lens has two crucial parts, something called total beta and another called passive alpha.
So, let's talk total beta. This is the key to everything. It's not just the beta you get from the stocks you own. No, it measures the hidden equity risk in everything else. Even an asset like real estate has some connection to the stock market, some sensitivity to how the economy is doing. Total beta adds up all of this direct and indirect risk to give you the one true picture of your risk.
So how do you find this so-called hidden beta? It actually boils down to answering two simple questions. First, how much does an asset tend to move in the same direction as the stock market? And second, how much does it bounce around on its own? You combine those two things and voila! You can slap a beta value on pretty much anything. It's how you uncover the market risk that's hiding in every corner of your portfolio.
Now, once you've accounted for all the risk, all that total beta, any expected return that's left over, that's what we call passive alpha. And this is the good stuff. This is the part of an asset's return that has absolutely nothing to do with the US stock market. This is the real prize, return that isn't just you getting paid for riding the market's roller coaster.
And this leads us to a pretty mind-blowing shift in thinking, which is captured perfectly in this quote. The real reason people diversify today, it's not actually to lower their risk. We've already seen that doesn't really happen much. No, the real goal is to hunt for these little pockets of passive alpha to try and boost their total returns.
So, if the real game is hunting for alpha, then how should we be building our portfolios? Well, the authors suggest a totally radical new approach that basically flips the old way of doing things completely on its head. It's all about building what they call an alpha core.
Which, of course, brings up a really good question. If this passive alpha stuff is so amazing, it's return without market risk, why don't investors just throw 100% of their money at the assets that have the most of it? Well, that's where the real world gets in the way. The researchers have this great name for these real-world problems: dragon risks. These are all the messy, complicated things that don't show up neatly in a spreadsheet. Stuff like an asset is really hard to sell quickly, or the markets are too small, or you just can't get access to the best managers. These dragons are what force funds to put hard caps on how much they can invest in these high-alpha alternative assets.
So this leads to a completely new kind of upside-down way of building a portfolio. Instead of starting with stocks and bonds, you start with the alternatives. First step, you build your alpha core by figuring out the absolute max you can put into each alternative, keeping those dragon risks in mind. Step 2, you mix those together to get the highest possible return. And then only at the very end, you use plain old stocks and bonds as swing assets to dial the portfolio's total risk to exactly where you want it.
And this table here lays it all out perfectly. Just look at this.
60% of this entire portfolio is the alpha core, which is made up of all those alternatives. That's the engine, right? It's contributing most of the return and about half the risk. The other 40%? That's just stocks and bonds, the swing assets that are being used to fine-tune the final beta to that target of 0.57.
So when you put all this together, this beta-based way of looking at things, it really changes the rules of the game for any long-term investor. It suggests a whole new way to think about your investment strategy.
Most big institutions, they have to live inside what the authors call a policy box. Just imagine a chart of risk and return. There's a floor, a minimum return they absolutely have to hit, and there's a ceiling, a maximum amount of volatility they're allowed to take. Their entire strategy has to exist inside that little box.
And since we now know that most funds end up pushing right up against that maximum volatility ceiling, the whole competition changes. It's not about who can take more risk or less risk. The real game is about who can build a better alpha core to generate a higher return at that exact same level of risk. It's a vertical race up the chart, not a horizontal one.
Okay, so let's boil all of this down. What are the big takeaways? First, the real goal of diversification for many people is actually to boost returns by hunting for alpha. Second, the only true measure of your portfolio's risk is its total beta, which counts all that hidden stock market risk. Third, these sources of alpha, they don't last forever. They're like magnets. They attract so much money that the extra returns eventually get competed away. And that leads to the final and most crucial point. Your investment policy can't be set it and forget it anymore. It has to be fluid, dynamic, and constantly reviewed.
And that leaves us with the billion-dollar question, or maybe the trillion-dollar question, that every long-term investor has to wrestle with. The sources of alpha that worked great yesterday are getting crowded and fading away today. So the constant, evolving challenge is simply this: where in the world will tomorrow's returns, tomorrow's alpha actually come from?
Welcome to The Explainer, where we break down big ideas. Today, we are diving into a really powerful concept from some Morgan Stanley research that, honestly, could completely change how you think about investment skill. It's all about something called beta targeting.
You know, it's the one question every single investor asks. How do you really separate genuine talent from someone who just got lucky riding a market wave? And it's surprisingly hard to do because there's a ton of statistical noise that just gets in the way.
We're always told to go chase alpha, right? That's the manager's special sauce, their ability to beat the market. But the incredible force of beta, which is really just the market's general tide, can make it almost impossible to see what's actually going on. You know, a rising tide lifts all boats. But the real question is, does your captain actually know how to navigate? So here's our game plan. We'll start by digging into why measuring alpha is so tough. Then we'll uncover the hidden noise that's causing all the problems. After that, we'll introduce the solution, beta targeting, and finally, see how this all comes together for managers and the big money sponsors.
Okay, so let's get right to the core challenge here. Without a really clear framework, simple up and down movements in the market can totally distort our view of a fund manager's performance. It makes it almost impossible to know, are they actually any good? So here's the crucial point. If a fund's sensitivity to the market, its beta, is unstable and just drifting all over the place, it becomes nearly impossible to get an accurate read on the manager's actual contribution, their alpha. It's kind of like trying to measure how tall someone is while they're jumping up and down on a trampoline. It's just a mess. So where is all this confusion coming from? Well, it turns out there's a very specific kind of noise that's causing this distortion. And it's not just random market chance. It's a real measurable effect. And it has a name. You see, investors often look at a fund's relative volatility to get a sense of its active risk. But here's the problem. That one single number is actually a mashup of three very different things. And one of them, well, it's the source of all our problems. Okay, now this slide is really important because it unpacks that relative volatility. You've got the beta gap, which is basically the fund's average tilt toward the market. Then you have the intrinsic tracking error, which is the true risk, the good kind of risk that a manager takes with their unique stock picks. But right there, stuck in the middle, is the villain of our story, beta volatility. That's the instability creating all the noise. This beta volatility, it acts just like static on a radio. The manager might be playing a beautiful melody, generating real alpha, but this static is so loud it just drowns out the signal. It makes the manager look way riskier and a lot less skilled than they actually are, and it just confuses everyone.
All right, so if beta volatility is the big problem, what in the world is the solution? Well, it's a surprisingly simple and really powerful discipline called beta targeting. It's all about filtering out that static.
Now, this does not mean every manager suddenly has to have a beta of 1, perfectly hugging the market. Nope. It just means the manager picks a beta that fits their style. Maybe it's 0.8, maybe it's 1.2, and then they actively work to keep it consistent. They commit to a target, and that filters out all that distorting noise.
And here's where it gets great, because this is a win-win for everyone involved. For managers, it means their real skill isn't hidden by all that noise anymore. Their performance numbers actually reflect their talent. And for the sponsors, the huge pension funds and endowments, it gives them a stable, predictable building block they can use to construct their entire portfolio.
Okay, talk is cheap, right? Let's actually see the evidence. The Morgan Stanley research uses some great simulations to show us just how much damage this beta volatility can do to how we perceive a manager's performance. So first, let's start with a fund's total volatility. Just think of this as the biggest, top-level, messiest number. It's the standard deviation of all the fund's returns, and it lumps in every single source of risk all together. Okay, so now we peel back the first layer. We account for that average difference between the fund and the market, that beta gap we talked about, and the risk number we see, this relative volatility, it gets smaller. So we're getting closer to the truth, but the number is still inflated. It's not the real story yet. You see that leftover gap? The space between the perceived risk and the manager's true active risk? That is the distortion. That is the static. And it is caused purely by an unstable, volatile beta. That right there is the exact problem that beta targeting is designed to solve. Now, let's see what this does to maybe the most important metric of all, the information ratio. Just think of it as a skill score. It's the alpha a manager generates for every unit of risk they take. So a manager might have a true skill score of 0.5, which is pretty darn good. But once you add in the noise from beta volatility, look at that. Their perceived skill just plummets. They get unfairly penalized for something that has absolutely nothing to do with their actual stock picking ability. And hey, don't just take my word for it. The source paper puts it perfectly. This isn't some minor rounding error. Beta volatility can completely wipe out the statistical evidence of a manager's talent. It can make a genuinely skilled manager look no better than average. Okay, this is where we need to zoom out. This isn't just some abstract theory that applies to 1 or 2 funds. No, this is absolutely critical for how large institutional funds, the ones managing billions in pension and endowment money, think about and manage their overall risk. And get ready for this number because it is an absolute bombshell. For most of these large funds, even ones that are super diversified across all kinds of asset classes, over 90% of their total risk comes from one single factor: their exposure to the stock market, their total beta. Now, what's so wild about this is that even a portfolio that looks incredibly diversified, like a university endowment with money in private equity, real estate, hedge funds, it still gets about 90% of its risk from beta. It is by far the dominant force. And if it's the dominant source of risk, well, then controlling it has to be job number 1. So this whole idea leads to a really powerful framework for thinking about different kinds of investment styles. The paper calls it the alpha/beta matrix, and it helps us classify how different strategies deal with this fundamental trade-off. So you have your beta grazers. Those are just your passive index funds. And on the other end, you have opportunistic foragers. But beta-targeted strategies, they fit into this really special category called alpha hunters. They're not passive, but they're not taking wild, unmeasured bets either. They're systematically and scientifically hunting for alpha, all within a disciplined, risk-controlled framework. So what does it actually take to make this work? It's not magic. It requires real discipline. First, you need a clear, explicit beta target. Second, you have to keep the drift around that target, the beta volatility, very low. Third, the manager's active risk needs to be truly separate from the market. And of course, the manager has to have real skill worth measuring in the first place. At the end of the day, a stable beta is the clean foundation that allows true alpha to be built and, more importantly, to be seen. So I'll leave you with this. The next time you're analyzing a fund, don't just ask about its alpha. Ask about the stability of its beta. Because that one question can move you from being someone who just looks at past returns to being a much, much savvier analyst of true investment skill. Welcome to The Explainer. Today, we're going to pull back the curtain on long/short funds. We're We're going to look past all the usual kind of confusing metrics and focus on one single number, a number that can tell you almost everything you need to know about a manager's real skill. So let's kick things off with a little puzzle. You're looking at two different investment funds, right? And on the surface, they both look pretty good. Solid returns, a smart-sounding strategy. But how can you really tell which manager has genuine skill and which one is just, riding a market wave? How do you spot the actual talent? All right, here's the game plan for today. We're going to start by talking about why the surface-level numbers can be so deceptive. Then we'll dig in and find what we're calling the active core. After that, I'll introduce you to this super powerful ratio. We'll also see how the structure of a fund can change everything. And finally, we'll see how this all fits together in a universal framework. Okay, first up, beyond the surface numbers. The biggest problem right out of the gate is how funds usually talk about themselves. We always hear these big terms, right? Long exposure, short exposure, net exposure. But what do they really tell us? Well, here's the catch. Those numbers, they can be really misleading. Sure, they tell you how big the fund is and how much it tends to move with the overall market, that's its beta. But they tell you pretty much nothing about its potential to generate real, unique returns, what we call alpha. And that's because they just lump everything together in one big pot, mixing the generic market tracking stuff with the manager's actual high-conviction bets. So, to get a real picture of what's going on, we have to perform a little bit of, let's call it portfolio surgery. We're going to split everything into two very different piles. Let's dig in. In the first pile, you've got what we call generic positions. Think of these as the fund's utility players. They're usually things like index futures or ETFs. Their whole job is just to dial the fund's overall market exposure, its beta, up or down. They're absolutely not there to generate any unique special returns. And then you have the active positions. Now this is the good stuff. This is where the magic is supposed to happen. These are the manager's high-conviction bets, the specific companies they've spent months researching, the ones they believe will either crush the market, those are the longs, or totally tank, those are the shorts. This is the portfolio of their absolute best ideas. So when we just ignore all that generic filler and add up the total size of these active bets, both the longs and the shorts, we get a way more useful number, and we call it the activity level, or AL for short. This is the true engine of alpha generation in the fund. Okay, take a look at this example. We'll call it Fund A. On paper, its gross long exposure is 130%, but when we do our little surgery, we find out its active long exposure is only 90%. So what's that 40% difference? You guessed it, it's just generic stuff used to manage the fund's beta. This is huge. It means the part of the portfolio that's actually trying to make you money through skill is way smaller than the headline number would have you believe. All right, so this whole idea of splitting the portfolio into active and generic parts, it's the key that unlocks everything, because now we can calculate the real hero of the story, the activity ratio. If the activity level was the size of the engine, the activity ratio tells us how that engine is actually tuned for performance. Okay, let's make this interesting. Let's bring in a competitor, Fund B. Now, at first glance, Fund B looks like the clear winner, doesn't it? It's bigger, it's more aggressive. Its gross long position is 160% versus just 130 for Fund A. And its active long book is 120%, way bigger than Fund A's 90. So it's got to have more skill, right? It's making bigger bets. Well, hold on, not so fast. The real key, the thing that cuts through the noise, is their activity ratio, the AR. And the formula is beautifully simple. You just take the short activity level and divide it by the long activity level. That's it. And this ratio, this one little number, is the single biggest determinant of a fund's intrinsic skill, what we measure with something called the information ratio, or IR. Basically, it's risk-adjusted performance. So let's do the math. For Fund A, we take its 60% short activity and divide it by its 90% long activity. For Fund B, we take its 80% short and divide by its 120% long. And when you punch those numbers into a calculator, you get something kind of mind-blowing. They both have the exact same activity ratio, 0.67. What does this tell us? It tells us they're running the exact same core strategy. Fund B is just a scaled-up, more leveraged version of Fund A. And this chart just makes it crystal clear. We've plotted the information ratio. Again, that's our measure of skill for both of these funds. And look at that.
Even though they have totally different sizes, their skill curves peak at the exact same spot. It's proof that their underlying intrinsic skill is identical.
And what is that peak number? It's 0.93. Both funds have the exact same potential information ratio. All that extra activity in Fund B, it just acted like a lever. It scaled up the potential returns, for sure, but it also scaled up the risk by the exact same amount. The core recipe, the manager's actual skill, was identical.
Okay, so the activity ratio is clearly the star of the show. It's the main character, but it doesn't tell the whole story. It turns out the underlying structure of the fund, you can think of it as the DNA of its active bets, that also plays a huge part in how much potential a fund really has.
A huge piece of this puzzle is correlation. How do the long bets and short bets relate to each other? A really smart manager finds shorts that go up when their longs go down. That's negative correlation, and it's fantastic. It acts like a built-in shock absorber, canceling out risk and boosting their overall IR. But if a manager picks longs and shorts that both get crushed in a downturn, well, that's positive correlation. It reinforces risk, and it can absolutely destroy their performance. And another thing is how many positions they hold. This all comes down to conviction and opportunity. If a manager finds a handful of absolute golden ideas, bets that are way, way better than anything else out there, they should go all in and concentrate their portfolio. But if the opportunities are more widespread, with lots of pretty good ideas but no single home run, then it's actually smarter to diversify and spread the bets around. It's about matching your portfolio structure to the opportunity set.
So what's so cool about all this? Well, what this framework really gives us is a universal language. For the first time, we can compare totally different strategies on an even playing field. And we can even see how a manager might deliberately transform their own fund.
So now we can look at a classic long/short fund, an active extension fund, even a market neutral fund, strategies that look totally different on the surface. And we can use their activity ratio to understand their core alpha generating DNA. We can finally make a true apples to apples comparison of their engines, regardless of the chassis they're built on.
What's really wild is that a manager can use these ideas like a set of dials to completely reshape their fund. Let's go back to our friend Fund A. Say the manager's goal is to change it into an active extension fund, targeting a beta of 1.0. How do they do it? Well, they adjust their gross exposures, and crucially, they shrink their short book. This intentionally changes their activity ratio, dropping it from 0.67 down to 0.45. The result? A fundamentally different fund with a new risk profile. And here's the before and after shot. You can see it all laid out. The gross exposure is different, the net beta has doubled to 1, and the activity ratio has dropped, just like we said. And look what happens to the IR. It goes down from 0.93 to 0.82. This isn't a mistake. The manager has made a conscious choice. They've traded a little bit of their alpha efficiency to get the exact market exposure they wanted.
Okay, so let's wrap this all up. What is the single most important thing to take away from all this? What's the big idea?
It's this. Forget about gross exposure. Honestly, just forget about it. The next time you look at any long/short fund, you have to dig deeper. Look past all those surface-level stats. The real key, the number that unlocks the truth about a manager's intrinsic skill, is the activity ratio. That's the number that tells you what game they're really playing.
Welcome to The Explainer. Today, we're jumping into the world of active equity investing, but we're going way beyond just picking stocks. We're going to break down a really sophisticated strategy that tries to solve a huge puzzle. How do you chase after higher returns without letting your risk just spiral out of control?
So let's start with the central challenge for pretty much any portfolio manager out there. They're all trying to beat the market, right? That's what we call generating alpha. But the real trick is, how do you do it in a smart way? How do you squeeze out that extra return without just taking a complete shot in the dark? This is the question that really pushes all the innovation in finance. So to really get our heads around that, we're going to follow the evolution of a pretty powerful idea. We'll start with the basic hunt for alpha, then see how it grew into these advanced strategies called AE+. We'll look at them in action, weigh the whole risk-reward thing, and then finally, see what kind of surprising impact this can have on a huge investment fund. Okay, let's dive into our first section. To really get where these advanced strategies are coming from, you've got to understand the motivation behind them. I mean, why did investors feel the need to look past the traditional way of doing things in the first place?
You know, it really all boils down to one simple, powerful goal: get more alpha.
Just think of alpha as the extra value a manager brings to the table with their skill and their research. The entire point of these more complex strategies is to give those skilled managers a much bigger, more powerful toolkit to really put their best ideas into motion. And you can see this really clear evolution here. So traditionally, managers were long only. That means they could only buy stocks they thought would go up. Then came the first big innovation, the 31-30 strategy. This let a manager short, basically bet against stocks they didn't like, and then use that money to buy more of the stocks they absolutely loved. But even that was just a stepping stone to what comes next, this generalized AE+, which offers a whole new level of freedom. All right, let's get into this more flexible and powerful concept. It's called Active Extension Plus, or just AE Plus for short, and honestly, it represents a pretty significant leap forward in how these strategies are designed. So, what in the world is an AE Plus strategy? Well, the key thing is that it's a long-short portfolio, but it has this one critical rule. It's got to have a stable, well-defined target for its overall exposure to the market. We call that beta. You can think of beta as how much your portfolio gets pushed around by the market's tides. Now, unlike a 130-30 fund that's kind of stuck moving with the market, an AE Plus fund can aim for a lower beta, like, say, 0.7, which makes it less sensitive to those big market swings, and that is a huge change in thinking. And this quote just nails the core philosophy. See, beta is your market risk. That's the risk you take on just by being in the stock market. Alpha is your skill-based risk. It comes from the specific bets your manager is making. A+ strategies are designed to draw a really clean line between those two. You pick a predictable amount of market risk, and then you just unleash the manager to focus purely on generating that sweet, sweet alpha. This really shows you the key difference. Over on the left, you've got AE+, which is all about stability and predictable risk. But on the right, a typical long/short hedge fund, well, they might change their market exposure all the time, trying to time the market. And that can make it really, really hard to tell if their good returns came from actual skill or if they just got lucky on a market call. AE Plus is designed to get rid of that confusion. Okay, so the theory is great and all, but what does this actually look like in a real portfolio? How do these different approaches really stack up when you start putting some numbers behind them?
Now this table, this tells a really interesting story. On the far left, you've got your basic long-only portfolio. As we move to the right, the strategies get more and more advanced, ending up with two different kinds of AE+. Just scan down the rows with me for a second. Look at how total actives, that's the part of the portfolio that's actually working to generate alpha, just explodes. And then look at the bottom. See how that translates directly into higher total alpha and a much better return/vol ratio?
The first number that just jumps right off the page here is this one, 190% active weight. What on earth does that mean? It's the total percentage of the portfolio, both long and short, that's being actively managed to chase alpha. To put that in perspective, a traditional fund might have an active weight of maybe 50%. This AE Plus strategy is dedicating almost 4 times as much capital to the manager's best ideas. And here's the payoff. That huge increase in active weight leads directly to a huge increase in potential alpha. We're talking about an expected alpha of over 5%. That's more than triple what the traditional long-only portfolio could even hope to generate. This is the whole point of the exercise, to let a skilled manager really go after more alpha. And what's really cool is that there's more than one way to get this done. The first example here, AE Plus number 1, it gets that high active weight by spreading its bets out across a lot more stocks. The second one, AE Plus number 2, does it by making really concentrated bets on its absolute favorite ideas. Both are shooting for that lower beta of 0.7, but they take different routes to get to their alpha. But of course, as we all know, there is no free lunch in investing. More alpha usually comes with more risk. So the really critical question becomes, what kind of risk are we actually taking on here, and is the potential reward really worth it? This chart here shows you the first part of that trade-off. We're looking at something called tracking error, which is really just a fancy way of measuring active risk. How much the portfolio's returns are likely to be different from the market benchmark. And as you'd expect, as the strategies get more active, from long-only all the way to our aggressive AE Plus fund, that tracking error more than doubles. That's the risk you have to take to go after that higher alpha. But here it is. This is the crucial point. Look what happens when we measure the return we're getting for the total risk we're taking. This return to volatility ratio, you could call it our bang for the buck, it goes up, and it goes up significantly.
For that AE plus strategy, it's 0.81, which is way higher than the 0.52 for the basic long-only fund. And this is the key insight. We're not just taking on more risk, we're taking on more productive risk. Okay, but that higher tracking error might still seem a little scary. I mean, a 6 or 7% tracking error for one manager is a lot. But what happens when you're a huge institutional fund? And this is just one small piece of a much larger, very diversified portfolio. The source material makes this really fascinating kind of counterintuitive point here. It suggests that even though these strategies have high relative risk, compared to their own benchmark, their impact on the total risk of a massive fund can be surprisingly small. Let's see how that actually works. So this first table shows the impact on the fund's own tracking error. Imagine a big fund hires 5 of these managers, and each of them has a 7% tracking error. Well, if their strategies are a little bit correlated, you can see down in the bottom left that the fund's total tracking error only goes up by about 0.05%. Yes, it's an increase for sure, but in the grand scheme of things, it's tiny. But this next table, this is the really mind-blowing part. Let's look at the impact on the fund's total volatility, the number that really, really matters. The fund starts with a volatility of 10.45%. Now, even after we add 5 of those aggressive managers, each with a 7% tracking error, look at the bottom left. The total volatility only moves from 10.45% to 10.47%. I mean, that is an almost unnoticeable increase. It's basically a rounding error. So how is that even possible? Well, it's the magic of diversification. In a really big fund, the main thing driving risk is just being in the market. That's your beta risk. The active risk coming from these managers is mostly uncorrelated with that market risk, and it's also not very correlated with each other. And what that means is that most big funds are sitting on this underutilized risk budget. They have the capacity to add this kind of productive, alpha-seeking risk without really rocking the boat at all. So let's just tie this all together. AE plus strategies are this really sophisticated next step in the hunt for alpha. By setting a stable beta target, they create a clean break between market risk and manager skill. And that structure creates an incredible opportunity. An investor can add these highly active strategies, get the potential for much higher returns, all while having a surprisingly small impact on their portfolio's total risk. It's really a way to take smarter, more targeted risks. And all of this leaves us with a pretty provocative question for the future. In a world where it's getting tougher and tougher to beat the market, could this kind of intelligent, risk-controlled approach become the new normal for active management? It's definitely something to think about. Thanks for joining us on The Explainer. Let's talk about long/short strategies. They're a huge part of modern portfolio management. But what if I told you that some of the most common ways people build them are, well, just plain wrong? We're going to dig into why the standard playbook might actually be holding you back.
So, to kick things off, check out this pretty bold claim from our source material by Jacobs, Levy, and Starr. They say that even the pros, the really experienced ones, have been beguiled by an assemblage of myths and misconceptions. And look, this isn't just some academic thought exercise. This is about stuff that has a direct, real-world impact on portfolio performance.
So what are these big myths? Well, they're pretty much industry standard practices. You've got this idea that you can just build a long book and a short book and kind of smush them together, or treating long-short like it's this totally separate asset class. And the big ones, the ones we're really going to focus on, are these automatic rules about being dollar neutral and beta neutral. We're about to take a closer look at each one. Okay, so here's the game plan. First, we'll tackle that foundational myth about just blending portfolios. Then we'll get into the weeds on dollar and beta neutrality. After that, we'll figure out the right way to add a benchmark. And all of that is going to lead us to the big idea at the end, something called the integrated optimization mandate. All right, first up, this myth that you can cook up a long portfolio and a short portfolio separately and then just mix them. It sounds simple, right? It feels intuitive. But doing it that way completely misses the secret sauce of what makes a long/short structure so powerful in the first place. And here is the absolute crucial point. You have to stop thinking in separate long and short buckets. It is a mistake. An optimal portfolio is a single, unified thing. See, the blending approach fails because it completely ignores how your long picks and your short picks relate to each other, the correlations between them, and that's where all the value is. Okay, so let's move on to the first big rule people love to impose, building on this idea of integration. We're talking about dollar neutrality. This practice is so common that for a lot of people, it's just a golden rule of how you build these portfolios. So, just so we're all on the same page,
Dollar neutrality just means if you're long $100 million bucks of stocks, you're also short $100 million bucks of other stocks. Your net exposure is zero. It sounds really balanced, right? Disciplined, maybe even safe. But is it actually optimal? And that really is the million-dollar question, isn't it? If you had a perfect optimizer with no rules, under what specific market conditions would it naturally land on a perfectly dollar-neutral portfolio all by itself? And the answer is pretty much never. Forcing a portfolio to be dollar-neutral is an artificial constraint. I mean, think about it. Anytime you tie a manager's hands with a rigid rule, you're probably not getting their best work. Unless, by some complete coincidence, their best possible portfolio just happened to follow your rule anyway, and that coincidence is incredibly rare. So just how specific does that coincidence need to be? Well, dollar neutrality is only optimal when this very specific, very nerdy condition is met. Basically, it only works if the expected returns from all your stocks, after you adjust them for risk and weight them in a very particular way, just happen to perfectly cancel each other out. The chances of that happening in the real world? Basically zero. All right, next up is the close cousin of dollar neutrality, beta neutrality. This is another super common rule, especially for funds that call themselves market neutral. The thinking here is that you're hedging out all the risk from the overall market. You build a portfolio with a beta of 0. And in theory, your return should have nothing to do with whether the S&P 500 is up or down. You're isolating pure skill, or alpha. Sounds like the holy grail, right? So, you can probably guess what's coming next. We have to ask the exact same question. Is this rule a shortcut to a better portfolio, or is it just another trap that actually hurts performance? When would a truly optimal, unconstrained portfolio just happen to have a beta of 0? And yep, once again, it's the same answer. Almost never. Forcing beta to 0 handcuffs your manager. It stops them from fully expressing their best ideas. I mean, let's say their analysis shows that their best long ideas also happen to have high betas. A beta-neutral rule says, nope, sorry, can't have them. They mess up my spreadsheet. You're leaving returns on the table. The math here lines up with what we saw before. The optimal beta for your portfolio is not automatically 0. It completely depends on your forecasts. If you look at all your stocks and their beta-weighted, risk-adjusted returns are positive overall, then your optimal portfolio should have a positive beta. If they're negative, it should be negative. Beta should be an output of your process, not an input that you force on it from the start. So if we shouldn't be forcing these neutrality rules on our portfolios, how should we be thinking about market exposure? This leads us to what you could call the equitization puzzle. What's the best way to combine your active long and short picks with a benchmark, like the S&P 500? Turns out there are 2 ways to do this. There's the common suboptimal way, which is a 2-step process. First, you build your active portfolio. Then you decide how much of the S&P 500 to layer on top. But the optimal way is integrated. You solve for everything at once, your longs, your shorts, and your benchmark holding, all in one single optimization that sees how every piece interacts. And this right here is the key insight. Your perfect allocation to the benchmark isn't some static number you just set and forget. It's a dynamic weight. It's like a thermostat that should be constantly adjusting based on your appetite for risk, how confident you are in your active bets, and what you think about the benchmark itself. So when does it make sense to lean more into your own picks and less on the market? Well, exactly under these conditions. When you're willing to take more active risk, when your own stock picks look amazing, when the risk of your strategy goes down, or when the benchmark itself just doesn't look that attractive. It proves that your benchmark holding is an active decision, not a passive one. And on the flip side, you should hold more of the benchmark when you want to dial down risk. Maybe when your active strategy feels a bit more volatile, or when the expected return of the benchmark itself is looking good. It's all a constant trade-off, a balancing act within one single, unified framework. This all leads us to our grand conclusion, the big idea that really ties all of these pieces together. If you remember just one thing from all of this, please make it this. The source material is crystal clear. True, genuine portfolio optimization demands integrated optimization. It's not about separate sleeves, it's not about making decisions one after the other, it's about seeing the entire portfolio as one single interconnected system. So the big takeaway is to stop thinking in silos. Your longs and shorts are not separate. Your active picks are not separate from your benchmark exposure. The only path to a truly optimal portfolio is to analyze every potential holding, every relationship between them, all at the same time. This holistic view is where you really maximize your edge and manage risk properly. So I'll leave you with a question to think about. This whole analysis really challenges some deeply held habits in the industry. It should make us all ask, what other common practices in my own strategy am I just following blindly? What am I doing just because it's always been done that way, instead of questioning if it's really, truly optimal? Thanks for watching. All right, let's jump right in. For most of us, there's this one fundamental rule of investing that just feels like, well, common sense. But what if I told you that very rule, the one we all take for granted, might be secretly costing you, that it's forcing valuable insights to be left on the table? Well, this explainer is going to dig into the research to uncover a hidden and very costly flaw in the way most people invest. So here's how we're going to break it all down. First, we'll expose this hidden handcuff that's limiting most investors. Then we'll do a quick but crucial refresher on long versus short investing. After that, we get into the really juicy stuff, the efficiency puzzle, and then we'll see how a powerful simulation unlocked the whole thing. Finally, we'll look at some real-world data to understand what a pure bet on skill really looks like. All right, first up, let's pull back the curtain on this hidden limitation, this fundamental rule that's quietly shaping almost every single standard investment portfolio out there. Seriously, think about it for a second. What if your entire investment strategy was basically trying to win a fight with one hand securely behind its back? You'd be at a massive disadvantage, right? Well, the argument we're about to unpack is that this is exactly what's happening inside millions of investment accounts every single day. And here's the culprit. It's called the long-only constraint. And it's a rule so common, so default, that most of us don't even think of it as a rule at all. It just means you can buy stuff you think will go up, but you're forbidden from betting against something you're pretty sure is going to go down. That, right there, is the hand tied behind your back. Okay, so to really get why this constraint is such a big deal, we need to be super clear on the two different ways a portfolio manager can act on their research. So, on one side, you've got the standard playbook. Long only. You do your homework, you find companies you think are winners, and you buy them. Easy enough. But what happens when your research uncovers a real dog, a company that's just not going to make it? With a long-only strategy, the most you can do is, well, just not own it. All that valuable negative insight, poof, gone. Now, on the other side, a long-short manager can play both sides of the field. They can buy the good stuff, and they can short the bad stuff. They get to use their entire brain, the full spectrum of their research. Now, it's really important to know the research we're digging into focuses on a very specific flavor of this, called market neutral. The whole point here isn't to make some big bet on whether the S&P 500 is going up or down. No, by perfectly balancing the longs and the shorts, the strategy tries to get to what's called zero beta. In simple terms, that means its performance is designed to be totally independent of what the broader market is doing. The goal is to isolate one thing, and one thing only, the manager's pure skill at picking winners and losers. And that, right there, brings us to the core puzzle. If a manager has real skill, how efficiently can they actually turn that skill into returns for you, the investor? And more importantly, how much does that long-only rule get in the way? So to measure this, we need a yardstick. And in the world of finance, that yardstick is called the information ratio, or IR. Think of it like a skills score, or even a baseball player's batting average. It measures how much return they generate for every little bit of risk they take. So, a higher IR, that means you've got a more skillful, more consistent manager on your hands. And as Richard Grinold, one of the authors of the paper we're looking at, pointed out way back in 1989, strategies earn high IRRs by applying their forecasting edge many times over. It's not about one lucky shot. It's about consistency across hundreds and hundreds of decisions. Yeah, this idea definitely didn't come out of nowhere. There was this whole debate that raged through the 90s. At first, people were talking about diversification and costs. But then, a couple of researchers, Jacobs and Levy, they kind of shifted the whole conversation. They said, hey guys, you're missing the point. The real issue here isn't diversification, it's the constraints. And that's when our guys, Grinold and Kahn, stepped into the ring to finally, once and for all, put a real number on just how much damage that long-only handcuff was doing. And how did they do it? This is where it gets really cool. They used a powerful simulation to literally visualize the hidden cost of this rule that everyone just accepted as normal. The core idea is actually super simple, but it's profound. Every single time a manager does a ton of research and comes to a really strong negative conclusion about a stock, but is blocked from shorting it, that insight is just wasted. Think of all that work, all that analysis. It just gets tossed in the bin. The portfolio literally has no way to use it. Okay, so you might be thinking, sure, but how often does that really happen? Well, according to the study's model, for a pretty typical aggressive manager who's looking at about 500 stocks, it happens a mind-boggling 41% of the time. Let that sink in for a second. Nearly half the time, their best negative ideas are just slamming into a brick wall. And this is where it gets really weird, kind of counterintuitive. You would think that having more stocks to choose from is a good thing, right? More opportunities, more fish in the sea. But for a long-only manager, it's the opposite. As their universe of stocks gets bigger, their efficiency, their ability to actually use their skill, it just tanks. They have more and more ideas, but because of the constraint, they have less and less freedom to act on them, especially the negative ones. Which brings us to what is, without a doubt, the most jaw-dropping number in the entire paper. The simulation found that a typical U.S. long-only equity strategy is only about 49% efficient. I mean, just let that sink in. We're talking about half. Half of a manager's skill, half of their potential to generate returns is just vaporized, destroyed by this one simple rule before it even has a chance to see the light of day. And the authors themselves, Grinold and Kahn, they don't pull any punches. They say it flat out. The long-only constraint has enormous impact. It cuts IRS for typical strategies in half. This isn't some tiny rounding error we're talking about. It's a massive, game-changing effect. Okay, wow, so that's the simulation, and it's pretty damning. But does this stuff actually play out in the real world? Let's shift gears and look at the real-world consequences and the hard data. So one of the weirdest side effects of this constraint is this unintended bet on company size. See, because it's impossible to take a huge negative position on a company you don't own, managers are forced to express their negative views on the biggest stocks in the index by just owning a little less of them. The result? Their portfolios get this accidental tilt, this bias, towards smaller stocks, a bet they probably never even wanted to make in the first place. Okay, but what about the actual performance? Does taking off the handcuffs work? The study looked at 14 real-world market-neutral funds back in the 90s, and the results were pretty compelling. The median fund, the one right in the middle of the pack, had almost zero correlation to the stock market, which is what you want, and it delivered an information ratio of 1.00. Now, for those not in the weeds, an IR of 1.00 is considered incredibly strong. It's a sign of real, consistent skill. So what does all this data tell us? Well, first, that being market neutral isn't just some academic fantasy. It's achievable in the real world. The data proved it. The betas and correlations were basically zero. Second, as a group, these strategies had, and I'm quoting the paper here, remarkable performance during that time. And they did all this with a level of volatility that was pretty normal for an active fund. Bottom line, the approach worked. All right, so this all leads us to the big finish. Why does any of this actually matter? Why is freeing a talented manager from this one simple rule so incredibly important for investors? When you boil it all down, the appeal of a long/short strategy really comes down to three huge things. First, you've got freedom. You're taking off the handcuffs and letting the manager use 100% of their brain, not just 50%. Second, you get purity. It becomes a pure, direct bet on that manager's skill. There's no hiding behind a rising market or a benchmark. It's all on them. And third, you get portability. This alpha, this skill-based return, can be picked up and added to literally any market exposure you want. It's an incredibly flexible tool. So we'll leave you with this final thought to chew on. The standard, safe way of investing might feel comfortable, but the research is pretty clear that it forces you to operate with only half the information. So you have to ask yourself, is my portfolio built to hear only half the story, or is it built to see the whole picture? Welcome to The Explainer. Today, we're going to dive into a pretty powerful idea. What if the biggest thing holding back your investment returns isn't your stock picks, but a single, hidden rule you probably don't even think about? So let's just kick things off with a big question. Is it possible that the way your portfolio is built is actually stopping your best investment ideas from paying off? It's a huge question because it means you could be totally right about a stock and still get the returns all wrong. So here's the big idea from the research we're breaking down today. Most portfolios, maybe even yours, are kind of like driving with the handbrake on. And that handbrake has a name, the long-only constraint. All it means is you can only bet on stocks to go up. You can't bet on them to go down. And this isn't some minor detail. It's a rule that can actively sabotage your best insights. All right, here's our roadmap for today. First, we'll pull back the curtain on this invisible constraint. Then, we're going to put a hard number on the damage it actually does. We'll get into why the opposite, shorting, can be so valuable, check out the risk and reward balance, see what a truly rebalanced portfolio looks like, and then wrap it all up with how to put this into practice. Okay, first up, the invisible constraint. Let's really get into how the basic rules of the game might be capping your returns before you even start. To really measure this, we need a special tool. And the research gives us one. It's called the transfer coefficient, or just TC. You can just think of it as your portfolio's efficiency score. It's a number from 0 to 1 that tells you how much of your brain power, your good ideas, actually make it into your final portfolio. A perfect 1.0 means nothing is lost in translation. And here's the perfect way to think about it. Your investment ideas? That's your engine, just full of raw horsepower. The TC score, well, that's the transmission. A score of 1.0 means every bit of that power gets to the wheels. But a lower score, that's like having a leaky, slipping transmission. You're losing power somewhere between your big idea and your actual investment. Now for section 2, where we get to the really juicy stuff. We're going to put a hard number on just how much of that power is leaking out, and we're going to pinpoint the single biggest leak. Okay, check this out. This table is where it gets really, really interesting. The researchers started with a totally standard, fully constrained portfolio. You see it up top? A TC of just 0.332. That's like barely a third of your engine's power actually hitting the road. Then they started removing the constraints, one by one. Take away the industry rules, you get a small bump. Sector rules, another small bump. Removing market cap rules, okay, now we're talking. A big 45% jump. But watch what happens when they remove just one more rule. 108.1%. I mean, just let that sink in. The efficiency of the portfolio more than doubles just by removing that one single rule, the long-only constraint. This is not a small adjustment, folks. This is a complete game changer. So the million-dollar question is why? What is it about this one rule that's so incredibly restrictive? And that question leads us right into section 3, why shorting unlocks value. And the answer, believe it or not, isn't really about your stock picks. It's about the hidden structure of the market itself, specifically in the big indexes like the S&P 500. You see, here's the core of the problem. Market indexes like the S&P 500 are ridiculously top-heavy. A few giant companies just dominate the whole thing. For a manager who can only go long, this creates a massive imbalance. If you think a huge company like Apple or Microsoft is overvalued, great. You have tons of room to underweight it relative to the index. But what if you have a negative view on a smaller company? Well, then your hands are basically tied. And this chart right here, man, it lays it all out perfectly. Just look at this breakdown. The top 20 stocks in the S&P 500 make up a full third of the index. The next 76 make up the next third. And that last third, that's made up of the other, wait for it, 404 stocks. 404 companies all crammed into the same slice of the pie as just 20. It's wild. So what does that actually mean when you're managing money? Let's make it real. Say you think 2 stocks are equally terrible. One's a big company, weighs about 1.7% of the index. The other is a small fry with only a 0.1% weight. To show you don't like the big stock, you can underweight it by a full 1.7 percentage points. But the small stock, the most you can underweight it is 0.1. That's it. Your ability to act on your negative view is literally 17 times bigger for the large stock. For hundreds of stocks in the S&P 500, you have almost zero ability to express a negative opinion. Okay, so this all leads to the obvious next step. Section 4, the risk and reward trade-off. Because the answer isn't just to go out and short everything. No way. It's about finding that sweet spot, that perfect balance between unlocking your insights and managing your risk. Now, this is a really fascinating point. In a normal, long-only portfolio, the more risk you take to try and beat the market, the more your efficiency, your T-score, actually goes down. The constraints start to bind you tighter and tighter. But when you allow for shorting, something amazing happens. You can take on more risk and your efficiency can stay high. You're no longer fighting the market structure with one hand tied behind your back. So, the key lessons here are pretty straightforward. First off, any ability to short, even a tiny bit, makes your portfolio more efficient than one that's long only, period. Second,
If you're aiming for higher returns and taking more risk, you're going to benefit even more from having more freedom to short. Third, and this is a big one, there's an optimal amount of shorting for every risk level. And finally, you can definitely overdo it. Trying to force a ton of shorting into a low-risk strategy can actually backfire and make things less efficient. It really is all about balance. So let's pop the hood and see what this looks like inside the portfolio itself. How does relaxing this one little rule actually change where a manager focuses their attention and, their money? This table tells a really clear story. It shows where the action is, where the manager is making their big bets. In the standard long-only portfolio, look at that massive difference. 80% of the active bets are on the biggest stocks and only 8% on the smallest. It's completely lopsided. But in a portfolio that allows shorting, this is a 150-50 fund, look how much more balanced it gets. Activity in the smallest stocks jumps to 35%, and the largest comes down to 61%. And this bar chart just drives that point home, focusing on where the activity goes. The long-only portfolio, that blue bar, shows that the smallest stocks get a tiny sliver of the manager's attention. But by just relaxing that one constraint, look at the orange bar. The activity in that same group of stocks more than triples. It lets a manager's insights shine across the entire market, not just on the 20 biggest names. All right, this is all great in theory, but let's bring it back to the real world for our final section. How can you or I actually put these lessons into practice without becoming a full-time hedge fund manager? And this is maybe the most important and practical takeaway from the whole thing. The authors make it really clear. You do not need to go all in on shorting to get the benefits. You don't have to completely flip your strategy upside down. Even small, modest, controlled changes can get you a huge piece of the pie. Here's a super common practical way to do it. It's often called a 20-20 strategy. Step 1, you allow a pretty limited amount of shorting, let's say 20% of your portfolio's value. Step 2, you take the cash you get from shorting those stocks you don't like, and you use it to buy more of the stocks you really love. So the result, step 3, is you're 120% long, 20% short. But, and this is the crucial part, you are still 100% net invested in the market. Your overall exposure hasn't changed. So, does this small step actually work? Well, the proof is in the pudding, right? Look at this data. At a pretty typical risk level, a standard long-only portfolio is capturing about 68% of its maximum possible efficiency. But that simple 120-20 strategy we just talked about? Boom. It captures almost 85%. You get this massive jump in efficiency from a pretty small change to the old model.
And that leaves us with one final thought to chew on. The long-only rule is one of the most basic, fundamental assumptions in all of investing. And as we've just seen, just loosening our grip on it a little bit can unlock an absolutely incredible amount of potential. So it just makes you wonder, what other core assumptions are we all making about investing every single day? And what kind of potential are we leaving on the table by not challenging them?
Asset allocation, it's probably one of the most critical decisions any investor makes. But let's be honest, the standard tools we use can feel like a total black box, right? It just makes the whole process way more complicated than it needs to be. So today, we're going to dive into a framework called allocation betas that promises to bring some common sense and intuition back into the picture.
Okay, so here's the game plan. First, we'll tackle the problem with those traditional optimizers, why they're such a headache. Then, we're going to introduce a whole new way to think about risk using beta. From there, we'll break down returns into alpha and beta and see how that creates this really smart portfolio structure with core and swing assets. It all comes together in a much simpler, efficient frontier, and that, in turn, helps us find what they call the institutional sweet spot. Let's jump in. All right, first things first, why is this so hard? For decades, the whole world of asset allocation has been run by this mathematical process called mean variance optimization. And yeah, it's technically impressive, but it often leaves managers scratching their heads, feeling like they're just getting orders from some mysterious black box. I mean, it really makes you wonder, doesn't it? Building a portfolio should be about balancing your hopes for the future with your fears. It's a human thing. So why does the main tool for doing it feel so robotic and disconnected from our own intuition? Well, it all comes down to how we've been modeling it. This quote from the source material just hits the nail on the head. The whole process is supposed to be objective, right? You feed in a mountain of assumptions, returns, volatilities, correlations, and this machine spits out the perfect portfolio. But if you can't look at that result and understand why the model chose what it chose, how can you really have any confidence in it?
And this leads to something that pretty much everyone in the industry has seen or done. The optimizer gives you a portfolio that just looks bizarre, like it wants to put 40% of your money into something you've barely heard of. So what do? You go back in and start torturing the constraints. You add all these little rules and limits until the machine finally gives you an answer you can live with. But at that point, you've completely defeated the purpose of having an objective process in the first place. Okay, so if the old way is flawed, we obviously need a new way of thinking. And this brings us to the absolute core idea of this framework. Let's rethink what risk even means. Instead of some abstract number from a statistics textbook, what if we measured it against something we can all understand?
So in the standard model, you have a chart with expected return on one axis and risk, which is just volatility, on the other. Now, if you draw a simple straight line from risk-free cash up to U.S. equities, you see something pretty telling. A whole bunch of other asset classes, like international stocks or real estate, actually fall below that line. Judged this way, they just don't look very efficient.
And here it is. This is the big paradigm shift. For most investors in the U.S., what's the single biggest thing that drives their portfolio's risk? It's how sensitive it is to the U.S. stock market. So what if we just stopped using abstract volatility as our risk measure and started using an asset's sensitivity to U.S. equities instead? And this gives us our star player for today, allocation beta. Don't worry, it sounds more complicated than it is. It's calculated from the exact same data you'd use for a normal optimization, but it just reframes the question. It asks, how much does this asset class act like the U.S. stock market? A beta of 1 means it's a perfect mimic. A beta of 0 means it does its own thing. Simple as that. And this is where it gets really cool. When you redraw that same chart, but you replace volatility on the x-axis with our new allocation beta, look at that. Suddenly, every single one of those other asset classes jumps above the cash to equity line. This isn't some kind of statistical trick, it's a revelation. By measuring risk this way, we're finally seeing the true diversification value that was hidden inside that messy volatility number. So now that we have this new lens to look through, we can do something incredibly powerful. We can actually break down an asset's expected return into its core components. We can see where the returns are really coming from. In this framework, any asset's return is made of 3 layers. At the bottom, you've got the risk-free rate. That's just what you get from holding cash. On top of that, you have the beta-based return. That's simply what you get paid for taking on risk that looks and feels like the U.S. market. And then, the third piece, the really crucial part, is what's left over. That's the allocation alpha. Now, we have to be crystal clear on this. Allocation alpha is not the same alpha you hear about when some star fund manager picks a winning stock. This isn't about skill. This is a structural feature of the asset class itself. It's the part of its expected return that has nothing to do with the ups and downs of the U.S. stock market. And some asset classes are just loaded with this stuff. Take a look at venture capital. Wow. Based on the data in the source, it has a massive allocation alpha of over 7%. That means the huge majority of its expected return is supposed to come from sources completely separate from the public stock market. And then you get some really fascinating cases on the other side of the coin, like commodities. Just look at that allocation beta. It's negative. What that means is, based on these assumptions, commodities tend to zig when U.S. stocks zag. That makes them an incredible diversifier, not because of their own return, but because of how they behave relative to the main engine of their portfolio. Okay, so this theory is all well and good, but how do we actually use it to build a portfolio? Well, this framework leads to a beautifully simple and intuitive structure. You just divide all your assets into 2 distinct buckets. It's pretty straightforward. On one side, you've got the alpha core. This is your portfolio's return engine. It's packed with all those non-traditional assets like private equity, real estate, and hedge funds, the things that are rich in that special allocation alpha. Then, on the other side, you have your swing assets. This is your risk dial. It's just plain old U.S. stocks, U.S. bonds, and cash. You use these to turn the portfolio's overall risk level up or down. So the process here is basically the complete opposite of what a lot of people do. You don't start with a 60-40 portfolio and then sprinkle in some alternatives. No, you start with the alternatives. Step 1, figure out the maximum amount you're comfortable with in each of these less liquid, non-traditional assets. Step 2, bundle all of those together. That's your alpha core. And then step 3, you just use the swing assets, stocks, bonds, cash, to fill out the rest and dial in your exact risk target. And now we get to the big payoff. When you follow this simple, intuitive process, it doesn't just make your life easier, it fundamentally transforms the output. That classic, messy, confusing, efficient frontier suddenly becomes something, well, elegant and really easy to understand. What you get is this clean, three-part frontier. Down at the low-risk end, you're on the cash-to-core segment, mixing your alpha core with a bunch of cash. Way up at the high-risk end, you're on the equity extension, adding more U.S. stocks. But for most people, the most important part is right there in the middle.
That middle part is called the fixed core segment. This is where you've maxed out your alpha core holdings, and the rest of your portfolio is just a simple mix of U.S. bonds and U.S. stocks. By changing that mix, more stocks for more risk, more bonds for less, you can slide along this segment and find the absolute perfect risk-return trade-off for your goals.
Okay, so we've got this really neat theory, this simple frontier. But is it just a theory? Does it actually have anything to do with reality? Well, the last piece of the puzzle is seeing if this lines up with what big, sophisticated investors are actually doing. And this is the part that's truly amazing. When you analyze a whole bunch of real-world institutional portfolios, you find they aren't just scattered all over the place. Nope. They are tightly clustered right in the middle of that fixed core segment we just talked about. This framework doesn't just give you a recipe for building a portfolio, it perfectly explains why so many smart portfolios already look the way they do. That's the sweet spot. So this allocation beta framework does a brilliant job of simplifying the known world and giving us a much better map. But, the source material itself talks about dragon risk, that fear of sailing into uncharted waters, and it's a legitimate fear. So the question that this leaves us with is this. As our maps get better and better for the world we know, what new dragons are still lurking out there in the parts of the investment universe we have yet to explore?
Okay, so picture the wild kingdom of investing. Out there, you'll find two fundamentally different species. And today, we're kind of going on a safari to really understand this great philosophical divide between what we're calling the alpha hunters and the beta grazers. Let's dive in.
So on one side, you have the beta grazers. Think of them like a giant herd. They move together, they find safety in numbers, and they're happy to just feed on the broad market return, which is beta. Then, on the complete other side of the spectrum, you have the alpha hunters. These are your solitary, proactive predators. They thrive by tracking down and exploiting market inefficiencies to capture that really elusive prize, alpha. And this is key. It's not just about different tactics. It's a completely different way of seeing the world.
So, here's the game plan for our journey today. First, we'll dig into that core divide between hunters and grazers. Then, we'll define the two types of alpha. Because, yeah, there's more than one. We'll figure out where it hides, explore the hidden traps in our own minds, learn from some of the greats, and finally, talk about how you navigate this whole sea of ambiguity.
All right, let's kick things off with this fundamental split, hunters versus grazers. This isn't just some theoretical classroom debate. This is a real chasm that has gotten wider and wider, especially with the explosion of super active investment funds on one side and all the passive index funds on the other.
Right, so the really crucial point here is that this isn't a small disagreement. The grazers, they basically believe the market is mostly efficient, so the best you can really do is just ride its currents. The hunters, though, they believe the market is actually full of inefficiencies. It's got these little pockets of opportunity the real skill and discipline can exploit for much better returns.
So what exactly is this alpha that the hunters are chasing after? Well, it turns out not all alpha is created equal. There are two very distinct types, and believe me, one is a whole lot easier to find than the other.
First up, we've got what's called allocation alpha. This is the kind you get just by making smart, strategic shifts in your overall portfolio. So for instance, rebalancing a portfolio that's gotten way too heavy in one area. The source material has this brilliant analogy. It calls this protein from the supermarket. It's right there, it's accessible, it's valuable, and it's relatively easy to get your hands on.
And then there's truly active alpha. Now this is the wild game. You're not going to find this in a supermarket, you have to hunt. It comes from real skill, from tracking down these fleeting opportunities that are born from market mistakes and, frankly, irrational human behavior. It's rare, it's elusive, and it is the ultimate prize for an active investor.
Okay, so if active alpha is like wild game, where are the hunting grounds? I mean, it's not just everywhere. Alpha only exists in very specific environments, in the market's little pockets of inefficiency.
Just think about it. A perfectly efficient market would be like a barren desert for an alpha hunter. There'd be nothing to hunt. All the information would be instantly priced in. But, lucky for them, our markets aren't perfect, not even close.
They have frictions, they have barriers, and most importantly, they are driven by us, humans, with all our predictable psychological quirks. And that is where the opportunities are born.
Now, these opportunities really come in two flavors. On one hand, you have acute inefficiencies. These are like fruit shaken loose by a storm. They're pretty obvious and they get snatched up really fast. But the real hunting ground, the place for the serious hunters, is in the chronic inefficiencies. These are the ambiguous, persistent opportunities that are rooted in deeper issues, and they do not resolve easily or quickly.
And this quote just brilliantly illustrates the danger of hunting those chronic inefficiencies. You can be right. I mean, fundamentally, totally correct. But the market's irrationality can just keep going for so long that it forces you out of your position. And this is exactly why it requires such immense fortitude and a really long-term view to succeed here.
So, that begs the question, what is the ultimate source of these persistent, chronic inefficiencies? Well, the answer isn't found in some spreadsheet or fancy algorithm. Nope, it's found right inside our own minds.
And here are just a few of the mental traps that we all, and I mean all of us, fall into. We follow the herd. We desperately seek out information that just confirms what we already believe. We change our goals after the fact to make ourselves feel better. We ignore data that contradicts our story. Each one of these biases creates a distortion in the market, and that distortion is an opportunity for a clear-eyed hunter.
Let's just take confirmation bias for a second. We have this natural, powerful tendency to build an echo chamber around ourselves, right? We seek out experts who just confirm what we already think. But a true alpha hunter, they do the exact opposite. They actively go looking for contrary views because they need to understand why the market is priced the way it is long before they can ever claim it's mispriced. Oh man, and who hasn't felt this one? When things are going badly, our gut instinct is to just stick our head in the sand. We don't want to look. It's a state of denial. But this inaction, this avoidance during downturns is a powerful behavioral force that can warp market movements and create huge chances for those who are actually willing to open the envelope and act.
This table does a great job of summarizing how different people respond when the market is falling. First, you have the holders. That's the unopened envelope crowd. They do nothing. Then, the rebalancers, who are often institutions. They actually buy as the market falls, which has a nice smoothing effect. After them are the valuators, who could be contrarians or momentum players. And finally, you have the shifters, the ones who fundamentally change their strategy, and in doing so often just make the panic even worse.
So, if the market is just littered with all these psychological traps, who actually succeeds? I mean, who are the master hunters who've somehow learned to navigate this treacherous terrain?
Well, the source material names a handful of legends. And while their specific strategies might be different, they all share one critical, non-negotiable trait. They are all contrarians. They have the intellectual, and maybe more importantly, the emotional strength to stand apart from the herd, to act when everyone else is frozen by fear, and to be fearful when everyone else is getting greedy.
Charles Ellis just perfectly captured the beta grazer mindset with this quote. He said, "They're playing the loser's game, where you're just trying to avoid mistakes. The focus is entirely on not losing, just by consistently hitting the ball back over the net. It's a purely defensive strategy." The master hunters, though, they play a different game. They share these traits, they have incredible patience, a rock-solid philosophy they never waver from, and they are not afraid to concentrate their bets when they really have conviction. And this is so crucial. They have the fortitude to look wrong for long periods of time, sticking to their disciplined process even when it's really, really painful.
And this is how they play the winner's game. See, it's not about being aggressive all the time. Not at all. It's about playing that same disciplined defensive game until that perfect pitch, that grand opportunity, finally appears. And at that exact moment, they switch modes. They take a calculated but aggressive risk to proactively force a win. That is the very essence of the hunt.
So, we've explored the two tribes. We've looked at the prize they're after and their different methods. And now, it all comes down to a final choice for you. How do you navigate this vast sea of ambiguity that we call the market?
And what a perfect metaphor that is. You can choose the passive approach, hoist the beta flag and just float wherever the market currents happen to take you. It's safe, it's simple, and you'll get where the rest of the herd is going. Or you can choose to be an active hunter, constantly scanning that foggy horizon, knowing opportunities exist but are hard to see, ready to act the moment one comes into view.
Look, there's no single right answer here for everyone. Both paths have their own risks, their own rewards. The really crucial thing is to know which game you're actually playing. So the question I want to leave you with is this. On this vast, uncertain sea, what kind of sailor are you going to be?
Welcome to The Explainer. So today, we're going to dig into a really fascinating paradox that's right at the heart of modern investing. You see, for decades, huge institutional funds have been diversifying into all these complex alternative assets, all to try and reduce their risk. But what if all that complexity is just, well, an illusion? What if, under the hood, these incredibly sophisticated portfolios are all secretly making the exact same bet? Let's find out.
So here's the game plan. First, we're going to lay out this diversification puzzle that has even some of the top investors scratching their heads. Then, we'll dive into 4 really surprising truths that the data shows us, which will lead us to 2 crucial hidden factors, what we call implicit beta and implicit alpha. From there, we'll see how these ideas create a whole new hunters and gatherers way of thinking and a pretty radical new way to build a portfolio, before we take a peek into the future.
All right, let's jump right into the central puzzle. You know, for decades, the golden rule of investing has always been diversify. The idea is pretty simple, right? Don't put all your eggs in one basket. But what happens when you have so many baskets that you can't even tell what's inside them anymore? Well, that's the big challenge facing the world's biggest funds today. I mean, we've seen this massive shift away from the simple 60-40 stock and bond portfolio. These days, institutional funds are layered with real estate, private equity, venture capital, commodities, you name it. And yeah, on the surface, that looks super sophisticated, like a really smart way to manage risk. But all this complexity creates a kind of dangerous blind spot. When you can't see the big picture, how do you really know what you own?
So this gets us to the core question here. With all these different moving parts, what is the one thing that's secretly driving your portfolio's performance? Is it your real estate? Is it your venture capital bets? Or is there some single hidden force that's tying it all together? As we're about to see, the answer is kind of hiding in plain sight.
Okay, so let's get to the big reveal. When researchers dug into a whole bunch of institutional portfolios, I'm talking pension funds, endowments, the whole shebang, they kept finding the same 4 kind of counterintuitive truths popping up again and again. First off, despite having these wildly different strategies on paper, these funds are all taking on almost the exact same amount of risk. A simple 60-40 fund and a super complex fund loaded with alternatives both wind up with a total volatility somewhere between 10 and 11.5%. Just imagine you're a fund manager, right? You think you've built this unique, safer portfolio, only to discover you're basically in the same boat as everybody else. That was a huge shock for a lot of people.
Now for the real bombshell. Get this. Despite all those fancy alternative assets, over 90% of what makes these portfolios go up or down is still driven by a single factor, the U.S. stock market. All that diversification, all that complexity, it was supposed to protect them from stock market swings. But the data shows it just didn't work. When the stock market sneezes, these billion-dollar portfolios still catch a major cold.
And you know, that brings us to our third truth. When you measure a portfolio's total sensitivity to the stock market, and that includes all the hidden stock-like risk in its other assets, they all cluster in this same narrow range. This means a fund that on paper only holds, say, 20% in stocks can still act like it's over 50% invested in the stock market. All that alternative stuff, turns out it was just equity risk wearing a different hat. Okay, and this is the final really fascinating twist. All this diversification didn't actually reduce risk. We just saw that volatility stayed pretty much the same. So what was the point? Well, the real benefit was boosting returns. By adding these alternative assets, funds got a higher expected return for the same level of risk. They weren't making their portfolios safer, they were just making them more profitable.
So how is that even possible? How can you get higher returns without taking on more risk? Well, the explanation lies in these 2 really powerful ideas that let us kind of x-ray these alternative assets to see what's really going on inside: implicit beta and implicit alpha.
Let's start with implicit beta. The easiest way to think of it is like the hidden stock market DNA in an asset that isn't, a stock. For instance, a portfolio of office buildings isn't traded on the stock exchange. But if its value tends to rise and fall with the broader economy, just like the stock market does, then it contains hidden or implicit equity risk.
Let's make this super concrete with an example using real estate investment trusts, or REITs. As you can see here, by looking at how closely REITs move with the stock market and then adjusting for their volatility, we can calculate their implicit beta. And that result, 0.48, what's it telling us? It's saying that nearly half of this real estate assets movement is really just a shadow of the stock market. That's the hidden beta we've been talking about.
Okay, so if some of an asset's return is just a reward for its hidden stock market risk, what about the rest of it? Well, that's what we call implicit alpha. It's the extra return you get that has absolutely nothing to do with the stock market. And because this part of the return is independent of your main risk driver, it acts like a pure performance boost. It's the magic ingredient that raises returns without really raising the portfolio's overall stock market risk.
Let's go back to our REITs example. As the slide shows, we start with the total extra return REITs are expected to deliver. Then we calculate and subtract the portion of that return that's just a reward for its hidden stock market risk, its implicit beta. And what's left over? That 2.22%? That's it. That's the implicit alpha. It's the pure extra return we're getting just by diversifying into the specific asset class.
Now, to help all of this stick, the source material uses this really brilliant metaphor: investors as hunters and gatherers. This simple idea helps us move beyond those old labels of active and passive investing and gives us a much clearer way to think about where returns are actually coming from.
So here's the crucial difference. Alpha hunting, that's the traditional game of active management. It's aggressive, it's a zero-sum search for market mistakes. For every winner, there has to be a loser. But alpha gathering is completely different. It's the strategic process of allocating to different asset classes to capture those implicit alphas we just talked about. It isn't about outsmarting anyone, it's about being in the right place.
And this matrix just lays out the whole spectrum beautifully. At one end, you have beta grazing, which is just your basic passive indexing. Way over on the other end is alpha foraging, this hyperactive search for any opportunity. Our two key ideas sit right in the middle. Alpha gathering is the smart diversification we're focused on, and alpha hunting is that classic skill-based stock picking.
So what's the big takeaway for actually building a portfolio? Well, if we accept that the main benefit of alternatives is this athered alpha, and the main risk is still equity beta, then it means we've basically been building portfolios completely backwards. It's time to flip the whole process on its head.
You know the old way, right? You start with a core of stocks and bonds, and then you kind of sprinkle in some alternatives around the edges. This new approach says, nope, do the exact opposite. Start by building your alpha core. That's the collection of assets that are going to deliver that valuable implicit alpha. Then, and only then, do you use plain old stocks and bonds as simple tools to dial the overall risk of the portfolio up or down to your target level.
And the process is actually way more logical when you think about it. Step 1, form the core. You make the toughest decisions first, deciding your maximum allocation to each alternative based on things like fees and how easily you can sell them. Step 2, optimize that core by combining those assets into the best possible mix. And then finally, step 3, you use those simple liquid swing assets like stocks and bonds to adjust the final portfolio's risk level to exactly where you want it.
Finally, let's look to the future. What happens when everyone starts thinking this way? As alpha gathering goes from being a niche strategy to the new normal, the investment landscape itself is set to change pretty dramatically.
And this leads us to a classic market problem, right? When too many people discover a good thing, it stops being, well, so good. As billions and billions of dollars pour into these alternative assets to gather that implicit alpha, all that demand pushes up prices. And when prices go up, future returns go down. The very act of gathering alpha is what causes that alpha to slowly get competed away and just disappear.
So let's do a quick recap of the most important takeaways. 1. Those complex portfolios are way more similar than they look, all hovering in the same risk zone. 2. U.S. equity is still the king of risk, driving over 90% of the action. 3. Diversification has really been a tool to boost returns, not lower risk. 4. Implicit alpha is that secret sauce, the extra return from smart allocation. And 5. Building your alpha core first is a much more powerful way to build a portfolio.
This leaves us with a final, really critical question for the future of investing. As alpha gathering becomes crowded and those easy returns start to disappear, where are investors going to turn next?
The search for an edge will have to evolve, again, likely blurring the lines between gathering, hunting, and even more aggressive foraging, pushing the brightest minds out there to find the next undiscovered source of alpha. Thanks for watching.
Welcome to The Explainer. Today, we are diving deep into a really fascinating investment concept, one that shows why just being advanced or complex isn't enough to guarantee success. You know, there's a common belief that these sophisticated long/short portfolios are automatically more efficient. But it turns out there's a critical and often totally overlooked choice that can make or break their entire strategy. So here's our game plan for today. We're going to start with the promise of long/short investing, and then we'll uncover this crucial choice I mentioned, the gearing dilemma. That's going to lead us to a really surprising insight about risk. Then we'll look at the 2 big ways managers get this wrong, see the very real cost of that mistake, and wrap it all up with a powerful lesson that applies way beyond just finance. All right, so for decades, the thinking has been pretty straightforward. A long-short portfolio, one that can bet on stocks going up and bet on them going down, should be the purest expression of a manager's skill. It's supposed to be way more powerful than just buying and holding stocks. But is that really the whole story? Do all these portfolios work the same way? Well, it turns out the answer is a big, resounding no. How a manager chooses to structure their portfolio can have a huge impact. And one of the single most important choices they make is something called gearing. To really get this, let's walk through a scenario. Picture a portfolio manager. She's running a $100 million fund, and our clients have given her a very clear objective: hit a target risk level of 10%. Okay, first things first. Let's define our key term here, gearing. The easiest way to think about it is as leverage. It's basically a measure of how much capital a manager is deploying, both long and short, compared to the actual money they have from investors. So, if a portfolio has a gearing of 1, it means for every $100 from a client, the manager is holding $100 of stocks they think will go up, and they're shorting $100 of stocks they think will go down. So, our manager is now at a crossroads. She has 2 completely different paths she can take to hit that same 10% risk target. Path A, she can take her $100 million and build a portfolio with a few very risky, high-conviction bets. That's low gearing. Or there's Path B. She can use high gearing, leverage, to build a much bigger, say, $300 million portfolio, but fill it with much safer, lower-risk stocks. Now remember, both of these paths can be engineered to deliver the exact same 10% risk to the client. The mechanics under the hood, though, are polar opposites. So the question is, which one is better? And the answer, believe it or not, lies in this really surprising insight. For any given strategy, risk has a natural, optimal partner in gearing. And here's the absolute breakthrough idea. Risk and gearing, they aren't 2 separate dials that a manager can just twist independently wherever they want. No, they are intrinsically linked. For any given investment strategy, if you fix the risk target, that naturally determines one single optimal level of gearing. It's not really a choice, it's more like a consequence. And when you try to force a mismatch, let's say you pick a gearing level that isn't the natural partner for your risk target, you're actively damaging the portfolio. It's kind of like putting the wrong kind of fuel in a high-performance engine. You're not just making a small tweak. You are fundamentally crippling the strategy's ability to turn good ideas into good returns. Let's put some real numbers on this to make it concrete. In one analysis for a specific universe of stocks, a portfolio aiming for 5% risk found its most efficient point, its sweet spot, at a gearing of 1.26. That means being 126% long and 126% short. Any more leverage or any less, and you start bleeding efficiency. The strategy itself dictates where that sweet spot is. So what happens when a manager gets this wrong, when they drift away from that natural relationship? Well, they fall into one of 2 traps. The first trap is being undergeared. This forces the manager to take these huge, concentrated, all-or-nothing bets on just a few stocks to hit their risk target. The second trap is being overgeared. This is where they have so much leverage that they have to spread their bets incredibly thin, becoming so overly diversified that they dilute their best ideas into, well, a bland mush. So let's look for the evidence, the fingerprint, of an undergeared portfolio. To generate that high risk without enough leverage, it has to make massive bets on just a handful of names. And here's the dead giveaway. You'll see a huge number of potential investments, even good ones, assigned a weight of exactly 0. The manager is literally forced to ignore perfectly good ideas. Now, on the flip side, you have the overgeared portfolio. This one's forced to be timid, To keep the risk low despite having all that leverage, it basically has to buy a little bit of almost everything, ignoring how strong the manager's conviction is. The fingerprint here is the exact opposite. There's a weird absence of any small or near zero positions. Everything gets a piece of the pie, which just drowns out the very best ideas.
Okay, so this isn't just some academic theory. This mismatch has a real, tangible, and often significant cost to investors. Think of it like this. An efficient portfolio, one where gearing and risk are in perfect harmony, travels along a nice, straight path. As you take on more risk, your potential return increases proportionally. Simple, clean, efficient.
But when gearing is mismatched, the portfolio gets knocked off that straight line and onto an inferior, curved path. And at every single point along that curve, the manager is earning less than they could be for the amount of risk they're taking. That curve is the visible cost of being either too concentrated or too diversified.
And this drop in efficiency can be absolutely dramatic. A mismatched portfolio might only be 60% as effective as an optimal one. In a really severe case, that efficiency can plummet to a dismal 10%. That means 90% of the manager's skill is just being wasted, evaporated by a structural flaw.
And it gets worse. Believe it or not, when you factor in real-world things like trading costs, the penalty can be catastrophic. A poorly geared fund might have to trade so much to maintain its structure that the costs completely wipe out any potential gains. It can become a machine that is almost architected for guaranteed losses.
So, after all that, what's the big lesson here? What should we really take away from this deep dive into how portfolios are built?
Okay, let's boil it all down. First, success isn't just about picking winners. How you structure the portfolio is just as critical. Second, there is a natural, optimal relationship between risk and gearing, and you ignore it at your own peril. And finally, these mismatched portfolios leave behind clear fingerprints, like all those zero-weight positions that can signal a deep structural problem.
And this isn't just about investing. It's a powerful mental model for thinking about efficiency in pretty much any complex system. Think about a brilliant team stuck with a flawed process, or a powerful engine paired with the wrong transmission. The result is always the same: wasted potential.
And that leaves us with a final question to think about. In our own work, our careers, or the big projects we take on, what's our gearing? Are we applying our effort with the right structure to maximize our impact, or is there some hidden mismatch between our talent and our process that's holding us back from our true potential?
All right, welcome to The Explainer. Today, we're going to talk about what happens when you untie a portfolio manager's hands. We're diving into a strategy called 120/20, which is all about letting the experts act on all of their insights, not just the good ones. It's a way to unlock some serious firepower, and we're going to break down exactly how it works, and of course, bust a few common myths along the way. So here's our game plan. First up, we're going to look at the big problem that holds back most traditional investment managers. Then, we'll unpack exactly how the 120/20 strategy gets around that problem. After that, we'll start tackling some of the biggest myths out there about performance, risk, and where this strategy even fits in the investment world. So let's kick things off with this question, because it really gets to the heart of the matter. Imagine you're an expert, and your job is to pick the stocks that are going to win and the ones that are going to lose. But what if you were told you could only really fully act on your positive ideas? Well, that's pretty much the dilemma that a lot of traditional portfolio managers are facing every single day. And that leads us right into our first section. We're going to dig into this fundamental constraint that has really defined investing for decades, which is the challenge of trying to bet against a stock that you really don't like. Okay, so here's the core of the issue. In a standard, what they call long-only portfolio, the only way a manager can show they dislike a stock is to underweight it. That just means they hold less of it than its weight in a benchmark, like the S&P 500. But the most extreme thing they can do, their biggest negative bet, is to just own 0 shares. And as you're about to see, that's often not a very powerful move at all. Now, get a load of this number. For literally half of all the companies in the S&P 500, their actual weight in the index is less than 0.1%. So think about what that means. When a manager's biggest, boldest negative move is to just not own one of these tiny stocks, their decision barely makes a ripple. It's like trying to make a point by whispering it. So, if just not owning a stock isn't really cutting it, how do managers untie that other hand and make a real impact? Well, that brings us to the solution. These things called enhanced active strategies, like 20/20.
Okay, first things first, let's get a clear definition. An enhanced active strategy lets a manager do something called short selling. That's where they borrow and sell stocks they think are going to go down in price. But here's the crucial part. They take the cash they get from doing that and use it to buy more of the stocks they think are going to go up. So here's how the mechanics actually work in a 120/20 portfolio. It's actually pretty simple when you break it down. You start with $100, then the manager finds $20 worth of stocks they think are losers and sells them short. That move gives them $20 in cash. They take that cash, add it to the original 100, and now they can go buy $120 worth of the stocks they feel really, really good about. And this table just shows you the beautiful, simple math behind it all. You've got $120 in stocks you love, and you're betting against $20 in stocks you don't. So what's the net effect? Well, you still have exactly $100 exposed to the overall market's direction. That means your beta, which is just a fancy term for how much you move with the market, stays at 1.0, just like a regular portfolio. You haven't taken on more market risk, you've just rearranged things to give your manager's best ideas more room to run. All right, now that we see how it's all put together, we get to the really fun part. Busting some myths. Because, believe me, people have a lot of wrong ideas about what all this flexibility actually means for performance. Let's jump right in with myth number 1. This is the argument that, hey, managers already have the tools they need, so this whole short selling thing is just, a minor tweak. It's the owning zero is good enough argument. But the reality? Short selling is pretty much the only way you can create a negative bet that actually matters. Remember that stock with the tiny 0.10% index weight? In a normal fund, the biggest bet against it is just that 0.10%. But in a 120/20 fund, a manager can actively short it, turning that whisper we talked about into a loud, clear statement. It lets them fully act on their research. Okay, next up is a myth that's a little more subtle, but it's really important. This is the idea that the short side and the long side of the portfolio are two completely separate worlds. That being unable to short stocks doesn't stop you from buying the ones you love. But in the real world, the long and short sides are totally connected, especially when it comes to managing risk. So picture this. A manager loves one tech company, but thinks its main competitor is way overvalued. By shorting the competitor, they free up capital and risk budget to buy an even bigger slice of the company they actually believe in, all while keeping their total exposure to the tech sector perfectly balanced. It lets them make bigger, more focused bets on their very best ideas. Okay, let's be honest. When people hear words like short selling and leverage, it can sound a little scary, right? And that brings us right to all the myths surrounding risk. It's time to separate the fact from the fiction. Let's kick this section off with a classic. You know the old saying, if it sounds too good to be true, it probably is. This myth suggests that all this extra potential comes with absolutely no downside, no extra cost, the proverbial free lunch. Well, the source material here puts it perfectly. It's not a free lunch, it's a more complete lunch. And that's a huge distinction. See, there are real costs. You have to pay fees to borrow the stocks you're shorting, the management fees are usually a bit higher, and more trading means more transaction costs. The trade-off, though, is that you're paying for a structure that lets your manager's insights, both the good and the bad, be put to work fully. Now, this next myth, we really have to bust this one, because it confuses two totally different kinds of risk. The mistake here is thinking that because you have $140 in positions for every $100 of capital, you've just cranked up your market bet by 40%. And this table just lays the difference out so clearly. A 120/20 portfolio uses that structure to create flexibility. It unlocks the power to short, to make real underweight bets, all while keeping the market risk, the beta, at 1.0. On the other hand, just borrowing money to juice up a long-only portfolio, that does none of that. It just magnifies your exposure to whatever the market does, cranking your beta way up to 1.4. One is designed to amplify skill, the other just amplifies the market. So if it's not just a simple leveraged fund, then what is it? A lot of people hear shorting, and their minds immediately jump to hedge fund. But that's another big misconception, which brings us to our final section. This comparison is so important. Enhanced active funds, they're typically managed against a public benchmark, like the S&P 500. They tend to be transparent, you can see what they own, you can usually get your money out any day you want, and their fees are often tied to how well they beat that benchmark. Hedge funds, well, they often don't have a benchmark, can be pretty secretive about their holdings, might lock up your money for a while, and often charge big fees no matter how the overall market did. So here's the real takeaway for how you should think about this. A 2020 strategy doesn't belong in your alternatives bucket next to the hedge funds. It belongs right in your core stocks bucket. The best way to think of it is as an evolution of active stock management. It's a more flexible, potentially more powerful version of a traditional stock fund. And that brings us right back full circle to this perfect quote from the source authors Jacobs and Levy. It really is the essential takeaway. You're not getting something for nothing. You're paying for a more complete toolkit, which, in the hands of a skilled manager, can hopefully lead to a better result. It's all about efficiency and empowering expertise.
And all of this leaves us with one final big question to chew on. Now that we know these more advanced tools are out there, tools that let the experts act on their entire range of insights, shouldn't we as investors start expecting them to use every single tool they have to get the job done? That's really the evolution that a strategy like 2020 represents.
All right, today we're diving into a really cool and pretty sophisticated investment strategy called active extension. You might also hear it called 1330. The whole point? It's all about what the source material calls alpha hunting, basically the search for returns that can actually beat the market. And to get our heads around why this is such a big deal, let's start with a really simple analogy. Okay, so picture this. You're a sports gambler, right? But there's this weird rule. You can only bet on teams to win. You can never, ever bet against them. So you can put a ton of money on the teams you absolutely love, sure. But what about those teams you are certain are going to lose? Well, the best you can do is just not bet on them. That's it. And believe it or not, this is the exact same problem that most traditional investment managers face every single day. And that brings us right to our first section, the long-only manager's handcuffs. Let's really dig into why this betting for rule puts them in such a tough spot. So here's the deal. A traditional manager, we call them long-only, they really only have one way to show how smart they are, by overweighting the stocks they think are going to do great. So let's say Apple is, 5% of the S&P 500. They might make it 7% of their portfolio. That's their bet. But what about a stock they think is a total dog, a real loser? If that stock is only like 0.1% of the index, the absolute biggest bet they can make against it is to just not own it. Go from 0.1% to zero. That's a tiny, tiny bet. All their brilliant negative insights, almost totally wasted.
So, how do you break out of those handcuffs? Well, you need a totally different kind of strategy. One that actually unlocks the full value of what a manager knows, both the good and the bad.
And that's where this idea of an active extension strategy comes in. The most common version you'll hear about is called 130/30. The concept is actually pretty simple, but it's incredibly powerful. It gives managers the green light to short sell stocks, to actually bet against them. And then they can take that cash and double down on the stocks they truly believe in. Let's walk through exactly how this whole thing is put together. Okay, so let's build one of these from the ground up. We start with a totally normal, 100% long-only portfolio. Every dollar is invested in stocks the manager thinks will go up. This is our starting point, our baseline. Now here comes the magic trick. The manager goes out and finds stocks they have a really negative view on, and they short sell them. Let's just say, for our example, they short an amount that's equal to 30% of the portfolio's original value. Now this does two things. It places that bet against those stocks, but just as importantly, it generates a pile of cash. And what do they do with that 30% in cash? They immediately plow it back into their absolute favorite long positions. So what do you end up with? You've got 130% invested in the good stuff, and you're 30% short the bad stuff. But here's the really important part. Your net exposure to the market is still 100%, right? 130 minus 30. It's built to have the exact same overall market risk as that standard portfolio we started with. So what's the result of all this? You get a much, much wider hunting ground for alpha. The manager is finally free from those handcuffs. They can fully act on their negative views by shorting, and that frees up capital to make bigger, more concentrated bets on their highest conviction ideas. This is how you truly go hunting for alpha.
But, as any investor will tell you, there is no such thing as a free lunch. All this newfound freedom, this extra power to hunt for alpha, it's got to come at a cost, right? So what exactly is the price of more alpha? That cost, it's measured by something called tracking error. And all that is, really, is a number that tells you how much your portfolio is straying from its benchmark, like the S&P 500. A simple index fund, that's got a tracking error of 0. But a fund that's making bigger, bolder bets, both long and short, is going to have a higher tracking error.
It's basically a direct measure of how much active risk you're taking. Okay, now this table really lays out the trade-off perfectly. Using data straight from the source material, you can see that as you crank up the extension, from 0 in a normal long-only fund, all the way up to 50%, your potential alpha, your outperformance, it goes way up. But look what happens to the tracking error. It goes up right along with it. More potential reward, more active risk. That seems pretty straightforward, right?
But this quote from the source, this is really the turning point for this entire explainer. It asks a really deep question. Is 1 unit of potential return, that's the alpha, really the same as 1 unit of this particular kind of risk, the tracking error? Or, and this is the key, could it be that in the real world, this particular kind of risk isn't nearly as scary as it looks on paper?
And that brings us to the absolute core insight of all this research. It's this amazing, surprising twist that happens when you stop looking at this strategy by itself, and you start looking at what happens when you put it inside a huge, diversified institutional fund.
So here's the first piece of the puzzle. For a typical huge fund, like a big pension fund or a university endowment, the source material shows that a staggering 90 to 97% of its total risk, its total volatility, comes from just one thing, its overall exposure to the stock market. We call that beta. The individual risk from all the little pieces it owns, they're just a drop in the ocean.
Let's throw some actual numbers at this to make it real. So, based on the model in the source, a standard passively managed institutional fund might have a total volatility of, say, 11.17%. That's our new baseline.
Okay, now what happens if that fund decides to hire a traditional, active, long-only manager? Well, that manager's active risk, their tracking error, it does nudge the total fund's volatility up, but only to 11.36%. It's a tiny, almost unnoticeable increase. And now, for the big reveal. What if, instead, the fund hires one of these 1330 managers? A strategy with even higher tracking error. The total fund volatility moves to, wait for it, 11.40%. The increase from adding the supposedly much riskier strategy is practically a rounding error. It's incredible. So here's the big takeaway. That extra active risk, the tracking error from the 13/30 strategy, it gets completely swamped, to use the source's exact word, by the fund's absolutely massive pre-existing market risk. Because that tracking error risk isn't correlated with the market, its impact on the total portfolio's risk is mathematically tiny. So think about that. You get the potential for much, much higher alpha with a barely noticeable increase in overall fund risk.
So, given all that, how should we think about a strategy like this in the grand scheme of things? Well, the source provides this really fantastic framework for classifying different investment styles, and I think you'll like this.
I absolutely love this. You've got your beta grazers. Think of them like cattle, passively munching on broad market returns from index funds. Then you have alpha gatherers, who diversify into new asset classes looking for other sources of return. And then you have the alpha hunters. These are the active managers using skill to find those extra returns. And finally, foragers, who are just opportunistically looking for returns anywhere they can find them.
And this just perfectly illustrates where these 130-30 strategies fit in. They are the quintessential tool for the alpha hunter. They're still tied to a benchmark, which keeps their market exposure consistent, but they give a skilled manager a much bigger, better toolkit to go hunt for outperformance, and they do it all with a surprisingly small impact on the one type of risk that really truly matters at the total fund level.
And this all leads to a final and, I think, pretty provocative thought. The source talks about these misunderstood risks as dragon risks. Like the dragons that old-timey map makers would draw on the parts of the map they hadn't explored yet. We've just seen that the tracking error from a 1330 strategy, well, it might be a much smaller, tamer dragon than we first thought. And it just makes you wonder, doesn't it? What other investment dragons are out there that we might be completely misunderstanding?
Welcome to The Explainer. Today, we're going to dive into a really powerful investment strategy, one that goes way beyond just picking winners. We're looking at some groundbreaking research from the Journal of Investment Management to explore the world of long/short portfolios. And we're going to try to answer one huge question. When it comes to betting against a stock, how much is actually enough? For most of us investors, our toolkit is, well, it's pretty limited. You can buy what you like. That's what the pros call going long. But what about those companies you're just deeply pessimistic about? The ones you think are totally overvalued or about to be disrupted or just, poorly run? For most people, there's no direct way to act on that gut feeling. And this is where you start to see the limits of traditional investing. And that limitation, well, the pros call it the long-only constraint. And honestly, it's like a pair of handcuffs on a portfolio manager. It fundamentally restricts how they can express their views on the market, especially their negative ones. So what does this actually mean in the real world? It means a manager can show they dislike a stock, but only by not owning it, or maybe owning a little less of it. That's a really subtle, weak signal. It's like whispering your disapproval when you really want to be shouting it from the rooftops. They can't fully cash in on their belief that a stock is going to underperform, so their best negative ideas, the stocks they're most convinced will go down, are just left on the table, useless. So what if you could just take those handcuffs off? That's the whole powerful idea behind these long/short extension strategies. And for years, the most famous example, the one that really brought this whole concept into the mainstream, was the 130/30 portfolio. It was seen as this totally revolutionary way to empower active managers. And the way it works is, honestly, it's so elegant. It's a way to fund your absolute best ideas with your absolute worst ideas. So imagine you find the $30 of stocks you are most bearish on. You bet against them by short selling. And then you take that exact cash and you double down on the $30 of stocks you're most bullish on. All of a sudden, you're acting on both your positive and your negative beliefs with the same amount of force. Okay, now this is where we bust a really common myth. When you see a number like 130, you might think this is all about adding a ton of leverage, taking on massive risk. But it's not. See, that $30 short position mathematically cancels out $30 of the long position. So the portfolio's net investment in the market stays at a very familiar 100%. You're not actually taking on more overall market risk. You're just redesigning the portfolio to get more bang for your buck from your manager's skill. So these strategies are a huge leap forward. They solve a major problem by finally letting managers act on their negative views, and they got super popular. But all this success, well, it raised a new and really crucial question. It's a question that the researchers behind our source material set out to answer. For a long time, 130/30 just became the industry standard. It was almost the default setting. But was there any real science behind that specific number, or was it just kind of a convenient rule of thumb? Well, it turns out the research shows the answer isn't a fixed number at all. The perfect strategy isn't static. It has to be dynamic. So to get past just rules of thumb, the authors built this really sophisticated mathematical model. Their goal was to pinpoint the key ingredients that determine the optimal amount of shorting. Now, we're going to skip the complex math, don't worry, but the factors they uncovered are both incredibly powerful and, you'll see, surprisingly intuitive. Okay, so the ideal amount of shorting is this complex cocktail. It's a mix of the manager's own choices, like how much risk they're willing to take, and the actual state of the market itself. Things like how volatile individual stocks are, or how much the market is dominated by a few big names. Those things are changing constantly. And that's what makes the perfect strategy a moving target. And here's a really cool part the model highlights. It's not just about the market. It's about the manager's personal skill. So the more accurate a manager's predictions are, what the paper calls their information coefficient, or IC, the more shorting they should be doing. And that makes perfect sense, right? If you have a genuine edge, a real talent for spotting the losers, well, the strategy should give you a bigger platform to use that talent. So if all those market factors are always shifting around, volatility, correlations, you name it, then any fixed strategy, like the old 130/30, is pretty much guaranteed to be the wrong strategy at some point. And this isn't just a theory. When you look at the historical data, you can see exactly how this plays out. This is just fascinating. The researchers applied their model to decades of market history. Back in the dot-com bubble, individual tech stocks were just incredibly volatile and crazy. The model said, whoa, dial back the shorting, a 140/40 is about right. But then, just a few years later, in calmer markets, the model said, okay, let's crank it up to a 160/60 structure. And right after the 1987 crash, when basically all stocks started moving together, the model showed you needed an even bigger 70% short to get the job done. And get this, it's not just about what year it is, it's also about where you're investing. So a manager focused on the kind of narrow FTSE 100 in the UK, they just have fewer stocks to pick from. So the optimal short is only about 23%. But a manager whose playground is the much broader Russell 1000, well, they have way more opportunities to find those underperformers. For them, the model says an aggressive 180/80 structure is closer to optimal.
All right, so all of this brings us to the core insight of the research. And it's a really powerful idea for any investor, even if you never touch these kinds of complex strategies. It's about the very nature of what makes an investment approach work over the long haul, the willingness to adapt.
And there it is, right from the authors themselves. The takeaway here is crystal clear. The most sophisticated strategies are not set and forget it. They are not rigid rules that are carved in stone. They are frameworks built to adapt to a world that is always, always changing. If you hold your strategy still while the market moves around you, you're just setting yourself up for failure. At the end of the day, what this research really gives us isn't a single answer. It's not like the perfect ratio is 42%. Instead, it gives us a powerful new lens to see the market through. It helps us understand the hidden forces, volatility, correlation, concentration, that should be shaping a portfolio structure from one year to the next. It's all about being responsive, not rigid. And that leaves us with a pretty provocative thought, doesn't it? It challenges that conventional wisdom of just setting your asset allocation and forgetting about it. It forces us to think not just about what we own, but how and why our entire strategies should be evolving. It suggests that in the world of investing, really, the only constant is change. Thanks for joining us for this explainer.